This is actually super cool.
Like, lock the fuck in, boys and girls, because this is going to be a long day. Like, I'm just mentally, this entire day today, I've been mentally preparing myself for the amount of time and just speaking that I'm going to be doing to people through the camera, and marking up shit on the charts, because this is going to be essentially all about strategy, confluences, execution, pretty much the one of the three skill sets that it takes to become a profitable trader. And in order for us to turn profitable, we need three skills, which is understanding strategy, so understanding why and where the market wants to move with a high probability, understanding our own psychology, so how can we master our own minds, and then understanding our risk management so that we don't blow our accounts, so that we don't go on tilt. And psychology and risk management kind of go hand in hand, and that's what we're going to be talking about tomorrow. But today we are going to focus on what kind of everybody loves talking about and loves focusing on, which is strategy. And again, people often put a lot of emphasis on strategy. It's good to put emphasis on it, and it's good to make sure that you guys are doing everything correctly, marking out confluences correctly, and executing correctly so that you guys have a high probability in the markets. But it's also just 1/3 of the puzzle. If you guys don't have the other two skill sets, then you guys are kind of left in the dark, and you guys will just forever be unprofitable. And that's why I want to start off with strategy, and then that's why we have day 2 completely dedicated to psychology and to risk management. So make sure you guys show up to day 2 as well. And then day 3, we're going to be wrapping everything up. We're going to have another guest speaker come on for day 3. And yeah, we're going to have guests pretty much every single day. So again, this is going to be, if I'm unable to explain something or some sort of concept in a way that helps you guys digest it, then maybe the guest will be able to open your eyes to something that you guys haven't necessarily heard before or haven't necessarily been taught in a certain way. And that's why we're bringing on other profitable traders to be able to talk to you guys, because again, just the more minds, the merrier, to be able to explain these concepts. So that's that. Today, we're going to be talking about strategy and confluences. Before we end up doing that, I just kind of want to get on here and talk to you guys about, like, who am I, what my story is, and I'm sure a lot of you guys have either came here from YouTube or you guys already know who I am, but I want to give you guys a brief little overview of, like, how I even became the person that you guys know today as TJR when it comes to trading. So my trading journey actually started back when I was in high school. Okay, I got into crypto very early from a person that was on the football team, and he was pretty much just pitching us the idea on Bitcoin, unregulated currency. You can kind of tell the government to fuck off. And that to me was super enticing, because I was sitting there and I was in a weird situation in my own life where I didn't like anybody telling me what to do. I didn't know what I wanted to grow up and end up doing, and Bitcoin pretty much like represented all of that for me. And hearing that, I was like, okay, awesome. And I took a chance on it and ended up making a pretty good amount of money, but then ended up blowing all of it. And I'm sure if you guys have been in a situation like that before, where you guys are young, you guys come across a lot of money, what's the first thing that you're going to do? You're going to spend it, okay? Maybe you guys are in that situation right now. You get your first prop firm payout. What are you going to do? Boom, you're hitting Louis, you're hitting Balenci, you're getting yourself a fresh new pair of kicks. You're not investing that money, okay? Maybe some of you guys are smart enough to be investing your money, but I know me, back when I was a freshman in high school, that was not my game plan. My game plan was get in and spend a whole bunch of money. After that, time goes on, and that really like sucked me into the world of trading, ended up causing me to watch a whole bunch of YouTube videos, ended up causing me to read a whole bunch of books, and I just got really addicted to it. And it was the first kind of side hustle or thing that was outside of video games or outside of things that couldn't make me money, that was like directed towards making money, and it kind of like fueled that drive of, okay, this is kind of what I think I should be able to do with my life, or what I want to be able to do with my life. And then it was kind of just a spiral from there. Like or it's just like a snowball effect. I couldn't stop watching YouTube videos, and I'm sure a lot of you guys are the same. It's probably why you guys are here right now. I couldn't stop reading books. I was just like so infatuated with the concept of being online, looking at a chart that is connected to some form of a financial market, whether it's currencies, whether it's commodities, whether it's stocks, whether it's indexes, and being able to place trades almost as if it's a video game, and to be able to make money doing that. That to me was like super foreign at the time. And now, or that to me at the time was super foreign. And then when I learned about it, I was like, holy shit, that this is possible. And then ended up finding other people that were similar to me, to you guys, that were teaching people how to do this online. And that's really what sucked me in. And then, as you guys know, this is kind of the point in my story where the majority of you guys are at. It was just like that unprofitable journey of just being like, man, I really want to learn how to do this so fucking badly. You're watching just countless hours of YouTube videos. You're putting in a shit ton of time. You're taking notes every single day. You want to change your life. And it's just the most difficult, rough, brutal journey ever. And you're doing it alone, because at least when I was doing it and when I was learning how to do it, day trading was weird. I think that I, as like an influencer, have, I guess, helped clear the name of day trading and made it a little bit cooler. And maybe, you know, you guys are in high school or you guys are in college right now, and everybody is trying to learn how to day trade. Trust me, it's a lot more accepted now than it was back when I was learning. And I didn't really have anybody to help me out with this. I didn't really have any friends to like talk about it with. It was this super taboo subject of like making money online when you were in high school, and like the main focus for you should be like, yo, win the next basketball game, or like whatever, like what girl are you dating, and you know, like who's climbing the social pyramid, not who's climbing the money pyramid. But I was focused on other things, and that's how I'm sure a lot of you guys are right now. You guys are focused on trying to improve your life, and that was the position that I was in when things kind of started turning and changing for me in the right direction. It took around 2 years for me to turn profitable. And I think now you guys have it a lot better, where I think the vast majority of traders that are now profitable, that have several years of profitability under their belt, they look back at the years that they spent in that unprofitable journey, and for the most part, it averages out to around 2 to 3 years of being unprofitable. Versus now, I see a lot of my students, and I see a lot of you guys, or people coming from YouTube videos in the comment section of YouTube videos saying like, holy shit, bro, I watched this video of you explaining this, and it helped me turn profitable after 4 months of learning how to trade. And that's the crazy thing to me, because since from me starting trading to where we're at now with just the online money education space, there's so much good information out there online, where I think you guys can actually shorten that profitability curve from being an unprofitable trader into turning into a profitable trader much faster than it was for me. Because when I was learning how to trade, there was just a lot of bullshit online, and it was mainly just showing like the highlight reel of what trading can give you. Versus now, like there's mentors online such as myself that show you guys the true, raw, and unfiltered version of trading, which is like, look, losses are involved with trading. There's losing months. Like, fuck it, bro. Last October, I was net negative on the month. But having mentors like that in your space, and the people that are actually teaching you, that is going to be super beneficial for you guys in making sure that your profitability curve is a lot shorter than it was than mine. Because for me, it took 2 years for me to turn profitable, because I was looking at all of these mentors that were online at the time, and I was like, man, these guys win every single day. Man, these guys are so freaking successful, and it seems like they never lose, and they're just doing everything right. What am I doing wrong? And that was a big thing that fucked me up. And I just thought that every single day was supposed to be a win. So I was striving to make sure that every single day was a win, when in reality, in order to be successful in trading, You actually need to have a couple losses. Not every single day is going to be a win. And what we need to do is just zoom out on a much longer timeline to see, okay, am I just getting 1% every day? And getting 1% better every day involves losses, because guess what? How are you supposed to grow? You're supposed to take losses and then you learn from those losses, and that's how you get better. Nobody gets better by winning every single day, right? If you win every single day, then how the fuck are you supposed to get better? You're just going to redline, right? There's no progress, there's no nothing. It's just like win, 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 win. And unfortunately, that's not how life works, and that's not how trading works. There's not just going to be a win every single day. Losses are guaranteed, not only in life, but also in trading. So we know that losses are guaranteed in life and in trading. So what can we do to make the most of them? We can learn from them and we can turn them into areas to grow. And that's the position where every single one of you guys is at right now, where maybe you guys are getting on this 3-day educational event, and you guys are taking losses, and you guys are expecting that your life and your trading journey should just be win, win, win.
Jeez.
For me was one of the most difficult things when I was trying to turn profitable, is just like finding my people and finding a community or an environment that could embrace me. And for me, I wasn't even able to find that until
Sorry about that. Muted for a little too long.
really until I moved out here to Puerto Rico, where I ended up surrounding myself with
kind of
a
missing
bunch of
story
other
time,
super
that's all.
successful entrepreneurs that were doing their thing, whether it be making money online or making money in other places. And again, that's our goal with doing something like this, is to put all of you guys together so that you guys can be in a like-minded community and just show you guys like, hey, you're not alone in this journey. And the fact that every single one of you guys is showing up today and putting in this effort, it's telling me that, hey, like, you guys are on a good track and you guys are ready to fucking rock. And you know, the journey gets lonely, and I'm not here to promise you that it's going to be over tomorrow or it's going to be over in 2 or 3 days or when this 3-day combine is over, but I'm here to tell you that there is light at the end of the tunnel, and let me be that light to you guys, and hopefully we can make that light a lot brighter by kicking this shit off, okay? So with that being said, before I even get into like concepts and stuff, I'll get into this right now and then I'll go pee. But again, when I'm nervous, I need to like pee all the time. So you guys will and this is going to be a long weekend of me spending time with you guys. So there's going to be a lot of honesty from me talking to you guys through the camera. You know, there are definitely going to be pee breaks. There might even be number 2 breaks. We'll see how gnarly things get and we'll see how long these things last for. But my goal is to give you guys every single piece of information necessary, and we're not logging off until I'm done with it. So you guys signed up for this and I signed up for this to be able to give you guys all the information necessary. Let's lock in. So the first thing that I want to talk about is what trading even is, and kind of give you guys an overview of how you guys can make money. I'm sure the vast majority of you guys kind of already know this, but we're going to do a simple breakdown. Okay, let's talk about Apple, the company, for example. Okay, so let's do a basic high school breakdown, economics, class breakdown of how you guys make money day trading. Okay. I say, okay, awesome. I want to buy 1 share of Apple. Boom. I punch it into the brokerage. Okay. Awesome. I get 1 share of Apple at the current price that it was listed at, that I press buy on. Boom. A week goes by and then I want to sell that share of Apple. That price that I bought it at a week prior is going to fluctuate for a week, and it's either going to go up or it's either going to go down. Maybe it goes sideways, maybe it chops around for a little bit, but when I sell it a week later, more often than not, it's going to be a different price than what it was the week prior when I bought it, and I'm either going to sell that share for either a profit or a loss, okay? And what we do as day traders is we do this at scale, okay, with leverage. And we use leverage in 2 different forms, okay, either via options or futures, okay? I personally trade futures, and I think that's what the vast majority of you guys do. If you guys trade options, then there's no problem with that. It's just going to be, it's just like a different form of leverage, okay? I personally trade using futures, and I think that that's what the vast majority of you guys use, but regardless, doesn't matter. But instead of us buying just a singular share of Apple and then having price fluctuate for around a week and then selling for either a profit or loss on a individual share of Apple, because let's go ahead and let's look at what Apple's price is right now. 1 singular share of Apple is worth $268.47 right now. Okay, so with that in mind, Apple's price isn't going to be able to make us $10,000 in a singular day if we're only buying 1 singular share of Apple, right? Because Apple would have to go up $10,000, right? We have to buy way more shares of Apple in order for us to try and make $10,000 on these small price fluctuations, right? Because the Apple's price may only move $5 or may only move $10 over that week span that we buy, hold it, and then sell it for, right? So that's what these brokerages do for us. They help us use leverage to not only help us buy more shares or more contracts of these stocks, these indexes, these commodities, these currencies, but they also leverage our account balance to give us a lot more, again, leverage or account equity that, or buying power to be able to buy. Instead of 1 share of Apple, we can buy 1,000 shares of Apple. So then instead, if Apple moves up $5 in price, instead of buying 1 share and then selling 1 share, what happens when we're able to buy 1,000 shares and then sell 1,000 shares? Then awesome. Our profit is, instead of being $5, it's now $5,000. And that's what these brokerages help us do, okay? And that's essentially what day trading is. Instead of the most standard, like older way of investing where you just like, hey, I'm buying individual shares of Apple, we're going through brokerages and they're giving us leverage on our initial account balance to give us more buying power so that we're able to make drastic amounts of money on small price fluctuations. Now, let's give a even larger example, and then we'll move on here, of something like the NASDAQ or something like the S&P 500. The NASDAQ is valued at $25,166 per contract right now. So that's saying, okay, I need to even be able to place a trade on the NASDAQ right now, I need to have $25,166 in my account. Not every single one of you guys has that type of money in your account, and that's just to buy 1 share. And let's just look at how much the NASDAQ fluctuated in price today. The NASDAQ moved down around 1.86% today. So that fluctuated around $468 approximately. Okay, so you're putting in, if we're using the standard route, you're putting in $25,000 approximately to only get a gain of $468. That sounds horrible. Maybe that's good over the vast long span of the NASDAQ and we're talking about investing, but when it comes to day to day, and when you guys see me making these big profits on my Instagram stories or on my YouTube videos, okay, I'm not buying individual contracts of the NASDAQ with my hard-earned money. Okay, we are using leverage that these brokerages give us to be able to leverage our money, to be able to give us more buying power so that we can buy more contracts of these indexes, commodities, and stocks, to be able to give us those wider profit and loss fluctuations. Okay. Now that we understand how we're able to use leverage to our advantage, I want to talk about what our goal is with trading, okay? And this is going to be something that you guys hear me repeat all throughout today and all throughout tomorrow and all throughout the third day. The goal of trading, and what is trading? You guys, like, before I even say what it is, I want you guys to answer this question to yourself. What do you think trading is? Okay, I'll give you guys like whatever 30 seconds for you guys to sit there and
put it in the chat.
What is trading? What is your goal of trading? Okay, what's the goal with trading? Give you guys, a little bit of time to think about this.
We want to understand why we're profitable.
Most people think that this is a trick question. It's not a trick question. Well, it kind of is a trick question because everybody gets it fucking wrong. But yeah, okay, cool. You guys have in your head what your goals are with trading, okay? What is trading? What should be our number one goal with trading? To make money.
Yup.
Wrong. If you guys said your goal of trading is to make money, then you're wrong, and that's probably why you guys are unprofitable right now. Believe it or not, just having that headspace and just having that in your head is probably one of the main deciding factors for why you guys are unprofitable right now.
You think so?
What is the goal of day trading? What is the goal? It isn't to make money, okay?
Put your thoughts in before you answer.
Our goal with day trading is to predict where price wants to go with a high probability, okay? Our goal with trading, write this the fuck down because the way that you guys think about trading changes everything. The goal of trading is to predict where price wants to go with a high probability on a day-to-day basis. It is not to make money. Because let's go through the definition that I just gave you of what trading is. If it is our goal to predict where price wants to go on a day-to-day basis with high probability, what is the awesome side effect that gives us?
That's a good point.
It gives us money, okay? Because if we're able to predict where price action wants to go on either the NASDAQ or the S&P 500 or on gold or on Apple stock, okay, if we're able to predict where price wants to go with a high probability every single day, then that is going to help us make money. But your goal of trading is not to make money. And we're going to talk about later on today and tomorrow why that leads you guys to make horrible mistakes in trading, and why that's probably one of the leading reasons for why you guys are unprofitable in trading. But you guys need to think of that like literally every single day before you guys get into the markets. Like why are you here today? Why are you looking at the charts right now? It is to predict where price wants to go with a high probability. Okay. And something else that I want you guys to understand is that no
The answer
one
was in the workbbook, man.
has
Damn it,
a
man.
100% probability in the market. Not a singular person has a 100% win rate. So when we are trading, it's based off of probability, which again, going back to what I was talking about to you guys before, means that there are going to be losses involved. Trading, no matter what, no matter how long you guys do it for, you are going to be guaranteed that there is a loss involved. Why? Because it's literally in the definition of what trading is and what our goals are with trading. Probability, a high probability. That doesn't mean that we have a 100% win rate. That means that we have a 70% win rate. That means we have an 80% win rate. That means that there is losses involved. Okay, so now that we have the definition of what trading is, we need to think about, okay, well, so how do we even build probability in the first place? How do we build that win rate? It's through pattern recognition, it's through strategy, it's through confluences, and it's through experience. Okay, and before we move on from this point, I want to use an analogy. You guys are going to hear me give like 100 different basketball analogies throughout this entire weekend and throughout this entire combine. But it's just super easy for me to relate the two. If I'm a basketball player in the NBA, how do I make more money? Do I go onto the court and think and just say, give me money? I'm here to make money? No, how do I make more money as a basketball player? I play fucking good basketball. And what's involved with playing good basketball? Putting the ball in the hoop, dribbling well, passing well, grabbing rebounds. Okay? There's multiple skill sets that build up a good basketball player. And in turn, being good at basketball makes you money. Okay, so if I'm trying to make money as a basketball player, I don't go out on the court and I don't think, and if I'm like, man, I want a contract extension or I want to get the max contract and I'm going into a season, I'm not thinking every single game, I want to make money. I'm thinking, how can I play to the best of my abilities? Because what's the side effect of that? Making a lot of money. So every single one of you guys, when you guys are, for the most part, when you guys are getting into the markets and you guys are looking at the markets on a daily basis, I'm sure the vast majority of you guys are getting in there and you guys are just like, oh, I want to make money today. And that is causing you guys to make horrible decisions in the markets. Versus if you get into the markets and if you think, okay, how can I make a highly probable decision on where price wants to go today? Then that's probably going to limit the trades that you take. That's probably going to limit the risks that you put on. Okay. And that's also going to cause you to make good decisions instead of making poor decisions. Versus if you get into the market thinking, I want to make the most amount of money possible, what's that going to cause you to do? It's going to cause you to over risk. It's going to cause you to take a random ass trade for no particular reason because in your head, you're just thinking money, money, money. How can I make money? You see the chart go up, you're going to press buy. And then you're going to be sitting there with your hands on your head, with your account blown, thinking, where did I go wrong? I tried to follow TJR strategy. No, you didn't follow TJR strategy. You tried to justify little bits and pieces of TJR strategy that you saw on the chart that you thought would work, and you thought, okay, well, this didn't show up and this didn't show up, but it looks okay for me because I want to make money today, so I'm going to, boom, put my whole account balance on this horrible ass trade. Versus if you guys come into the market every single day thinking, I want to have a high probability of predicting where price wants to go. That's my main focus. That's my main goal. I want to execute the strategy flawlessly every single day. That's what's going to lead you to being a profitable trader. That's what's going to lead you to be good at trading. Being good at trading means that you have a high probability in the markets of predicting where price wants to go. That's it. And money is just an awesome side effect that comes along with doing that. Okay. Now, something that I mentioned to you guys before is that profitable traders have 3 skill sets that they need to master in order to become a professional. You guys have the strategy skill set, you guys have the psychology skill set, and you guys have the risk management skill set. Without all 3, you guys are going to fail every single fucking time. You guys can have the best strategy in the world that gives you guys a 95% win rate. But if your emotions are out of control, then what does that mean? Then you won't be following that strategy that gives you the 95% win rate every single time, because you're going to end up taking FOMO trades. You guys are going to end up exiting too early. Okay, everybody thinks that strategy is what turns people profitable. No, you need to have all 3. Because if you have the best strategy in the world, but you don't have risk management and you don't have a control over your mental and control over your own psychology, then you're going to be risking way too much on certain trades if you don't have risk management. And then what happens? Okay, we know that no strategy has a 100% win rate. So what happens when you risk the entire account balance? You don't have the skill set of risk management, and you risk the entire account balance on one of those trades that just so happens to be a loss. That's a drop in the probability bucket of that 95% probability strategy that you have. And it ends up losing. It's part of that 5% chance of you losing. Uh-oh, too bad, so sad, account's gone. And now you suck at trading and you're not good. You're unprofitable. You need all 3. You not only need to be able to predict where price wants to go, but you also need to be able to do it with a high probability. That all has to do with strategy. But being able to do it with discipline every single time and not falling into your emotions, that's psychology. And being able to put on proper risk management so you can maximize the wins, minimize the losses, that's what's going to lead you guys to help boost your profits up and minimize the losses that you guys take. And a lot of you guys, I would like to say the vast majority of you guys have strategy down, like to the fucking T. But I would also like to say the vast majority of you guys aren't following the strategy to a T every single day, because your discipline fucking sucks, your risk management fucking sucks, and your emotions are all over the place. And as much as I love you guys for getting on here and doing this whole thing with me, I'm going to be brutally honest with every single one of you guys throughout this entire event. I'm not going to sit here and tell you that, hey man, you're a profitable trader now. Like, no the fuck you guys aren't. We need to drop our egos at the door right now. Every single one of you guys signed up to this for a fucking reason. Every single one of you guys signed up to this because you have a problem in your trading. So you signing up to this is admitting to me and every single other person in here that you are unprofitable. So you need to sit yourself down right now and look yourself in the mirror before we get into any of this and just tell yourself to your fucking face, you are unprofitable. I don't give a fuck if you guys have gotten a funded account payout before. You still signed up to this and you're telling yourself, and you told me that you need help with your trading. That's literally admitting that you are not good enough yet. So a lot of you guys are going to be maybe hear something that I say in here and be like, nah, I don't need to listen to that. You guys signed up to this shit for me to tell you what you are doing wrong. You guys literally told me by getting in here and by listening to me
It's
that
true.
you aren't good at trading right now.
Lost $800 a week and a half ago, man.
Do me a fucking favor and listen to me, please. Like, I'm actually begging you guys. There's so many people that will go through and like watch YouTube videos or they'll sign up to some fucking mentorship or they'll do something like this and they'll think that they're smarter than the person that's teaching them and they'll close off their brain to any sort of knowledge that I have to give to you guys or that the other speakers have to give to you guys because you think that you're better than them for who knows what reason. Like, bro, you signed up to this shit because you aren't seeing the results that you want to see. So let me do my job and you do yours as a student. Before we get into any of this, that is what I'm here to do. So we need to strip our egos at the door. Every single one of you guys in here, I don't give a fuck if you guys got a funded account payout. I don't care if you guys have multiple funded account payouts. You guys came here for a fucking reason. It's because you guys are not profitable and you guys need help with your trading. Cool? That's where we're going to start today off with. Every single one of you guys is not good at trading. It's the sad, but it's the fucking truth. You guys are not good at trading right now. It's harsh, but that is why I am here, to help you guys get better. So when I tell you these things, and as we go throughout today, and as we go throughout tomorrow, if you hear me say something and think, no, that's not right, imagine I'm reaching through the camera and slapping you in the face, because who are you to say what's right and what's wrong? You signed up to something literally telling yourself that you aren't good at what you're trying to learn how to do. So let's have an open mind as we get into all of this, and just, I know it sounds crazy, but just fucking trust me. Like, I have spent years in this market trying to figure it the fuck out. I've like literally had years and years and years of mistakes and of lessons learned. I've been through it fucking all. I've seen all the fucking YouTube videos. I've read all the fucking books. I've seen literally multiple year cycles of these equities markets, of these commodities markets, of these currency markets. I have so much experience in these markets and I have so much information that can be beneficial to you guys. You guys just have to be open to it. Okay, so that being said, let's get into the first skill set or one of the three skill sets that every single person needs. And that tends to take the biggest priority of all of you guys that love to learn how to day trade. Okay, every single one of you guys is just like strategy. You know, that's what we're starting with today because it takes the most amount of time to go over, because there's a lot of confluences and there's a lot of like explaining technical shit. But strategy is simple, guys. Like a lot of you guys think that it's your strategy that's fucking you up. It's actually not. Like, strategy is about as easy as it gets. Like, just, you're going to watch me go over these confluences and go over step by step how to put it together. Like, once you have the steps and once you understand how to mark out the confluences together, like, there's really not much else to strategy to show you guys besides just like follow that every single fucking day. And if it presents an entry, then you take it. And if it doesn't, then you don't take it. And like, that's it. Where you guys have the most issues is in psychology and risk management, because those two end up causing you to change the strategy. Those two end up causing you to not follow your plan and end up causing you guys to be unprofitable. So before we get into strategy, I need to go pee and then we'll go crazy on there. Okay, I'll be right back. If you guys need to go pee like I do and I'm like fucking dripping sweat, I keep adjusting my fan because I'm burning in here and I'm like bright red, then let's go pee and turn down your air conditioning if you guys are sweating like me.
Do people say turn up the AC or turn down the AC? Because the AC makes it colder. Can we talk about that for a minute? This guy takes a piss. There's no way, dog. Hey, yo. At least you got a good flow, man. It's a W flow, man. What the fuck? How many times you gonna shake it, chat?
Oh man, that was nice. Woo. It's hot. Alrighty, let's get into this. So again, before I pull up the charts and you guys start getting super freaking excited, just here to preface, okay? These confluences that I'm going to introduce to you guys help us have probability in the market, okay? They are not a sure thing, okay? And when, I know that sounds crazy, they are not a sure thing. And when used incorrectly at the wrong times and in the wrong context, they are fucking useless. Okay? Let me go through that one more time. And this applies to every single confluence that you guys have ever learned when it comes to trading. Okay? Confluences help us have probability in the market. But they are also not a sure thing. And when used incorrectly and at the wrong times and in the wrong context, they are useless. Okay, so if you guys, let's say for example, mark out a random liquidity sweep that happens at 5 p.m. Eastern time when the US stock market is closing and try to take a trade off of it, what do you think is going to happen? It's going to be like, what is that giving you? It's nothing. It's used incorrectly and it's used at the wrong time and in the wrong context. And in turn, that liquidity sweep is going to be fucking useless. A lot of you guys make this mistake. You guys just try and put the strategy and put the confluences anywhere on the chart. And it's crazy to me when I see you guys doing this because I'm like, what are we doing here? This is like, they are absolutely useless in these positions. So I'm going to show you guys and introduce these confluences with you guys. They help us have probability in the market. But again, when it's not used in the systematic manner that we have set up to give us the probability that it gives us in the market, then it's fucking useless, okay? I'm going to have to repeat that multiple times because some people are very stupid and it drives me fucking insane. And it makes me crazy, okay? But it is literally fucking useless unless used correctly. Okay, so that's why we need to have a strict strategy and a strict edge in the market. Because unless we're following that, then these confluences are a whole bunch of bullshit. And I'll show you guys several examples of how the confluences can be a whole bunch of bullshit. All right. Now, let's get into the charts, boys. So, let's get into this. So, the first thing that I'm going to teach you guys about is liquidity. Okay, identifying liquidity. Liquidity is arguably the most important concept that I'm going to teach you guys on the charts, okay? So keep that in mind, okay? Liquidity is by far the most important confluence that I'm going to teach you guys because every single trade that we take is based off of a draw on liquidity or based off of a liquidity sweep, okay? Something else that I want to tell you guys, every single one of these confluences that I teach, okay, happens on every single time frame and on every single chart, okay? So when I teach you guys liquidity sweeps, I could show you guys a liquidity sweep on the weekly time frame. I can also show you guys a liquidity sweep on the 1 hour time frame. I can also show you guys a liquidity sweep on the quarterly time frame. I can also show you guys a liquidity sweep on the 1 minute time frame. These confluences are not limited, or this strategy that I'm going to teach you guys is not limited to the time frames that we have up here, okay? This is not some like 5 minute right when the 9:30 candle closes, you're going to mark out a box around the 15-minute candle, and then you're going to go on the 5 minute, and then whatever direction it breaks out. Like, no. These confluences are going to be useful across every single time frame on every single chart. It's like these confluences are why the market moves the way that it does, okay? And it shows, okay, orders getting filled. It shows, okay, like liquidity getting drawn to. It shows orders getting closed, okay? Like these confluences help us understand these candlesticks on the chart, okay? So, liquidity. How do we spot liquidity? Liquidity lies above highs and below lows. And if you guys are a student of mine, you guys watch my YouTube video and you guys are like, I already know how to spot liquidity. Shut the fuck up, because what did we already establish with you guys coming in here today? You are unprofitable. So maybe this will be a good refresher for you, and I can promise you guys that you guys are doing something wrong within this entire lesson that I'm going to give to you guys today, because if you guys were doing it right, then you wouldn't be here, okay? So let's just, again, leave our egos at the door. If you guys have heard this before, then that's fine. I want you to watch it again, and I want you guys to take notes again, because I can promise you that there is something that you're missing, that you're doing incorrectly. So again, egos at the door here. Just need to stress that, all right? How do we identify liquidity, and where does liquidity lie? Liquidity lies above highs in the market and below lows in the market, okay? How do we identify a high in the market? With a move up, then a move down. How do we identify a low in the market? With a move down, then a move up, okay? Pretty freaking simple. You would think that that's pretty simple. However, there's a lot of people that like to identify lows as a move down, then a move down. And I'm going to show you guys examples of this on the chart. And there's some brainiacs that, for whatever reason, they think that a high is identified by a move up, then a move up. You know, in order to make a high, we need a move up, then a move down. So what does that mean? That means a green candle, then a red candle, and then we identify the highest point of those two candlesticks, okay? How do we identify a low? With a red candle, then a green candle, or a down candle, then an up candle, and we identify the lowest point of those two candlesticks. Pretty freaking simple, okay? So we know that liquidity and resting orders lies above highs in the market and below lows in the market, okay? That's where liquidity lies. Okay, now we're going to take a little break from this real quick, and I'm going to explain trends real quick, okay? So how we can identify uptrends and downtrends, because this is required for us to understand why liquidity lies above highs and why liquidity lies below lows. So an uptrend, how does an uptrend move? Whoa. My mouse is going crazy. How does an uptrend move? In higher highs,
yep,
and higher lows, right? This is what an uptrend looks like.
Switch, and
we have a high, then a low, then a higher high, then a higher low, then a higher high, then a higher low, then a higher high, and a higher low. And what does a downtrend look like? Lower highs and lower lows. I know this is super basic beginner shit, but it's going to end up making sense as we move forward. Okay, so we have a high, then we have a low, then we have a lower high, then we have a lower low, and this is essentially what a downtrend looks like, okay? Lower highs and lower lows. Awesome. So we know what an uptrend looks like, and we know what a downtrend looks like. Now, why is this beneficial when we're talking about understanding liquidity? Well, we know that when we're in an uptrend, typically when we move past or move above a high, that means that price is going to move higher. Okay, and then when we come down and then we move past the next high, it means, okay, price is going to move higher. And when we're in a downtrend, we come down and we make a low. And then we come up and then, oh, right when we push underneath this low, what is price probably going to do? It's going to keep pushing lower and end up making a lower low. So what does that cause price to do? When we come down and we make a low right here, when we push underneath this low, people are going to be placing sell orders underneath this low, okay? Why? Because they think price is going to move lower. Why? Because we're in a downtrend, okay? So there's a massive amount of sell orders that are sitting underneath lows. Now, also on the other side of this, there are some people that maybe they think that this move up is an uptrend, okay? So they think, okay, awesome, I'm going to buy right here, right here, right here, okay? What is that going to cause them to do? Where is their invalidation point of those buy positions? Where are they wrong? Well, they're wrong underneath these lows, right? So what does that cause those buyers to do? It causes those buyers to put their sell stops or their stop loss underneath these lows. So now there's two forms of sell positions underneath lows. Okay, there's people that are entering into sell orders as we are trying to hopefully potentially continue this downtrend. And there's people that are getting stopped out of their buy positions on this leg up as we come down underneath these lows. Okay, so we know there's a bunch of sell orders that lie underneath lows. Let's keep that in mind and let's transition back over to the uptrend. Okay, what lies above highs? Well, the opposite of what happens in downtrends. Okay, when we push above highs, there's people that are thinking, oh, well, since we're in an uptrend, we're going to go higher. So I'm going to place a buy order once we push above these highs here. Okay, awesome. We come up, we push past these highs. I'm going to buy. We're in an uptrend. And then boom, we make a whole bunch of money. And then also on the other side of things, on this mini little move down, there's some people that are thinking that this is a downtrend. Okay, and if they are incorrect about this downtrend, if they are shorting the market, if they are selling, okay, on this move down, where does that trade get invalidated for them? Above these highs, because that would mean that, hey, we're not actually in a downtrend, we're actually continuing this uptrend that we're in, or we're actually in an uptrend. So there's two orders that are sitting above highs. There's buy orders of people that are just entering into trades, and then there's also buy orders of the people who are getting stopped out of their trades. So now that we know how to identify trends, how to identify highs and lows within the market, and why and where liquidity lies within the market, we know that there's a massive amount of buy orders above highs in the market. We know that there's a massive amount of sell orders underneath lows in the market. Awesome. Now we know where orders lie in the market, and that's what liquidity is. Liquidity is just resting orders. Boom. Liquidity explained. There you go. I'm a freaking genius. You guys are geniuses now. You guys know what liquidity means. Liquidity is just resting orders. And where do resting orders lie? Above highs and below lows. Okay. Now, with that in mind, how is this beneficial for us? Okay, so we know that there are buy orders, massive amounts of buy orders above highs, and we know that there's massive amount of sell orders underneath lows. Now, what do we as traders want to do? We want to be able to predict where price wants to go with a high probability on a daily basis. How are we supposed to predict where price wants to go with a high probability on a daily basis? Well, the goal for us should be to follow the money in the market. Okay? How can we follow the money in the market? By looking at where the market makers want to push the market. Okay? We're not just looking at little fucking patterns on a screen and just hoping for the best. We're not just pressing buy right when market opens.
Whoops.
No, we're trying to identify why and where price is going to move. Okay?
You're not supposed to do that?
Liquidity helps us do that by identifying areas or spots in the market that have a large amount of orders that could potentially, keyword potentially, get filled. We don't actually know for certain where orders are going to get filled, but we can mark out significant highs and lows in the market, or just highs and lows in the market, and understand that price has a potential, or price has somewhat of a, price can potentially come down, fill these orders, and then move based off of that. Okay. Now let's also think about the market makers. If they want to push price in a certain direction, what do they need? They need somebody to fill their orders. Because just like how I was explaining to you guys, okay, let's go back to that high school stock share example. Okay, if I want to buy 1 share of Apple, I have to find someone that is willing to sell it to me. I need somebody that is willing to sell me that share of Apple at that exact same price that I'm willing to buy. Now, brokerages, they simplify this entire process for us. We don't necessarily need to call up all of our friends and be like, bro, do you have a share of Apple that, you know, like you're willing to sell to me at this price right here, that price is at right now? No, that's not the case. Brokerages do this for us. However, on a massive scale, like on the scale of moving the markets, okay, this is true, okay? But again, they're not calling up their friends saying, okay, you know, we need 1 billion people that are willing to buy right here at this price. Okay, no, what do? They move price so that those 1 billion people, or, you know, all of these orders get executed without them having to do anything. And then what does that give the market makers the opportunity to do? It gives them the opportunity to place orders in the opposite direction. Because if there's a bunch of buy orders that are sitting above
I haven't been talking
high,
much, but
and price
there's going to be
up,
some VODs on this. There's going to be clips.
it comes into this area.
All of the
there's a lot of people that are willing to buy at this price, which means the market makers are going to be able to fill their massive amount of sell orders
from TJR,
without
then they have the
causing
capability.
a drastic move in price.
Maybe he'll
because
find
if
me
we're,
you know, I'm putting a lot of effort into this, and I want to make this work.
Because if we're just sitting in like a regular point, like let's say like right here, okay, market is right here, and the market makers want to move price down. If they were to just enter into their sell orders right here, what would that cause price to do? That would cause price to go down and only fill a little bit of their sell orders right here, and then boom, it's going to cause price to drop. And then as price drops, there's going to be some people that are willing to buy at this lower price, so in turn it allows them to fill even more of their sell orders, and the price is going to go down even more. And then there's going to be more people that are willing to buy, and then that allows them to fill more of their sell orders. But they don't want their sell orders to get filled right here, and then right here, and then right here, and then right here, and then right here. They want the best price and the best entry available. So what do? Instead, they just say, hey, look, there's a high right here, or there's a significant high right here, and we know a vast majority of people are going to want to press buy when we push above this high. Why? Because we're going to be continuing this uptrend, and on top of that, the people that are trying to short on this move down are going to get stopped out of their orders. So we know there's a bunch of buy orders right here. What should we do to price? We should just push price up a little bit, get all those buy orders to get filled, and then what does that give us the opportunity to do? Fill our massive amounts of sell orders, and then awesome, all of our sell orders can get filled right here because our sell orders are going to match these people's buy orders, and then we can send price down in the direction that we want price to go in. That's what liquidity is. Okay, and then it's the same thing in the other direction with lows. Okay, they know that there's a lot of people that are willing to go short underneath these lows, but if they want price to move higher, if they know that they want to push price up, how do they get price to move up while getting the best entry possible? What are they going to do? They're going to push price underneath a low to be able to fill their buy orders and not drastically affect the price so that they can get filled at the best price possible while all of these people are pressing sell. They're just filling their massive buy orders. And then what does that give them the ability to do? It gives them the ability to move price higher. Now, you guys are probably thinking, okay, awesome. Whenever we push above a high, I press sell and I'm going to be a billionaire. No, that's not the case. And whenever we move underneath the low, I'm just going to press buy. I'm going to make money. That is not the case. Again, remember what I was saying before. okay? When price moves above these highs and below these lows, it just gives the market makers the opportunity to fill their orders. Doesn't always mean that those orders are going to get filled, and doesn't always mean that they are going to want to move price in that direction. It just is a highly probable area where orders can get filled, okay? So we don't press buy every time a low gets pushed underneath, and we don't press sell every time a high gets pushed above, okay? And this is also why we have other confluences, okay? Liquidity and identifying draws on liquidity is just one step in the right direction, because we're able to identify, and all of the confluences that I'm going to talk to you guys about today are going to help you guys move in the right direction and actually understand why price is moving at certain points, okay? So that's just the first thing, okay? We need to understand that we're not just pressing sell when we move above a high because, oh, the market makers are going to go short here. No, that's not the case, okay? And we're not just pressing buy when a low gets pushed underneath because, oh, the market makers are going to buy here. No, that's not the case. We have other confluences to help us identify if those orders got filled and if the trend is going to continue in the direction that those orders got filled. That's what all these other confluences are going to help us with that I introduced to you guys after liquidity. Now, before we move on from liquidity, and you're probably saying, whoa, dude, we haven't even learned about liquidity. Yes, you did learn about liquidity. Where does liquidity lie? Above highs and below lows. Believe it or not, it's like one of the easiest and simplest confluences ever. And believe it or not, all of these confluences that I'm going to talk to you guys about today are pretty fucking simple. A lot of you guys are caught up in a lot of bullshit that's put out to you guys online because they're trying to make you think that you need some secret key or some special confluence that's going to turn you guys into a profitable trader. When at the end of the day, you're not really missing much, okay? These confluences and the strategy can be really fucking simple, and the hard part is just staying disciplined to it. So again, what is liquidity and where does it lie? Liquidity is resting orders, and it lies above highs and below lows, and that is an area where the market makers have the possibility or the option to be able to fill their orders to change price's direction. Okay, now there's different types of liquidity. There's high resistance liquidity and there is low resistance liquidity. Now, before I show you guys this, I want to just show you guys examples of liquidity sweeps to show you guys that, hey, TJR, he's not talking out of his ass. This is like an actual true, real thing that happens. And I'm going to show you guys it happening on multiple time frames just to prove my point that these confluences do show up on multiple time frames. So right here, we're on the monthly chart. What do we know about liquidity? Well, it lies above highs and below lows. Cool. Well, let's go ahead and let's identify lows. Well, we have, and again, let's be careful here. Again, a lot of people mess this up. What is a high? A move up, then a move down. So on my chart, that means a blue candlestick, then a black candlestick. That doesn't mean a blue candlestick, then a blue candlestick. Okay, it means a blue candlestick, then a black candlestick. That has closed. Okay, for this, we'll just identify lows for now. And then in the other example, we'll identify highs, and we'll show you guys sweeps of liquidity in both directions, okay? So lows, that means a move down, then a move up, and we take the lowest point of those two candles. So we're looking for a black candlestick, then a blue candlestick. Well, there's a black candlestick right here, then a blue candlestick right here. Awesome, there's a low right here. There's a black candlestick, then a blue candlestick right here. The lowest point of those two candles, awesome. There's a low right here. We have a black candlestick, then a blue candlestick. Lowest point of those two candles, boom, there's a low right here. We have a black candlestick, then a blue candlestick. Awesome, there's a low right here. That low actually already got taken out by that one. We have a black candlestick, then a blue candlestick. The lowest point of those two candles, boom, there's a low right here. This is on the monthly chart. Okay, so we have a low right here. Price comes down, but buy orders weren't filled off of this low. Price didn't go higher from there. So again, that just goes to show that we can't just be pressing buy when we push underneath lows. we need to wait for our other confluences, right? And I'm not going to show you guys every single confluence on this right now, but this just proves my point that we can't just press buy when a low gets pushed under in the market, okay? We'll introduce the other confluences later. Okay, so this low, it was a draw on liquidity, but did price want to move off of it? No. We have a low right here. Awesome. Price comes down and does it reverse off of it? Nope. It wanted to go lower. So price had the opportunity to reverse underneath this low, but did it? Nope. We come down even lower. We have a move down, then a move up. Lowest point of those two candlesticks. We have a low right here. Price comes down and boom. Whoa. Just snorted up like a bunch of mucus. What do? We come down underneath this low, and then what did the market makers do? Oh my goodness, they were able to fill all of their buy orders all within here, and then what did that cause price to do from there? Fucking skyrocket. Price came down. It swept out a low. There was a lot of people that were willing to sell to the market makers so that they were able to fill their massive amount of buy orders right here. And then what did that cause the market to do? It went all the way up. All the way up. So that's an example of liquidity to the downside getting swept and then price reversing. Let's show an example of liquidity to the upside and then reversing. And let's show it on a different time frame. Let's see here. Let's go ahead and use the 4-hour time frame. And let's go ahead and show it to you guys on, screw it, this is fine. Well, I don't want to do this on a Newsday. We'll do it on this, okay? So let's look right here, okay? I'll just use this individual high. We won't mark out any of the other ones, but we get a move up and a move down. We mark the highest point of those two candlesticks. This is on the 4-hour chart. Again, I don't want you guys looking too deep into this. I don't want you guys figuring out, okay, well, then why did price move off of this high and then why is it now reversing over here? Okay, we're going to get into all of that later today. But it's just showing you guys that this happens where price will move above a high, fill orders, and then push price lower. So that's exactly what price did here. We pushed above a high, and then once we push above that high, move up, then a move down, the highest point of those two candlesticks. What did we end up doing? Boom, we ended up going lower. Okay, and then in the exact opposite direction, I'll show you guys this again. We have a move down, then a move up. We take the lowest point of those two candlesticks. We have a low right here. After we sweep liquidity to the upside to push price lower, what do we end up doing here? We sweep liquidity to the downside. Notice how price ended up moving underneath this low. Price comes underneath this low. What does that give the market makers the opportunity to do? Fill their massive amounts of buy orders to then push price where? Up and higher. Okay, and this happens every single day. This happens on every single time frame. I can show you guys it happening on the quarterly time frame. I can show it to you guys happening on the freaking, probably not the yearly time frame, but let's look right here. This is the quarterly time frame. Look, a move down, then a move up. Price comes down, takes out this low, and then boom, price ends up going higher. I can show it to you guys on the 5-minute time frame, on the 1-minute time frame. This is how orders are filled, and this is how the market moves. This is how the market makers are able to fill their orders and push price in the direction that they want to go. Cool? So where does liquidity lie? Above highs and below lows. Awesome. We showed you guys examples on the chart. We showed you guys how to identify uptrends and downtrends. We showed you guys how to identify highs and lows. We showed you guys examples of liquidity actually happening on the chart. Now I'm going to introduce to you guys different types of liquidity. There's 2 different types of liquidity. There is high resistance liquidity and there's low resistance liquidity. Okay, and I'm going to make this very simple for you guys to understand. So, sorry, I forgot that you guys are also taking notes, so I'm going to give you guys some time to write down high resistance liquidity and low resistance liquidity. Okay. Oh. gonna be a long day, boys. Got a lot of confluences to go over, but this is gonna be good. I'm pumped for you guys. Okay, so 2 different types of liquidity, and also before I was like so like high stress, and now I'm flowing. Okay, I'm a lot more relaxed. I don't know if you guys could tell, but when we first started this, I was stressed out, man. There's been a lot of time and effort that's gone into this to make sure that this goes smooth. And good for you guys. You know, we wanted to make this the best thing possible. So now I'm chilling. Anyways, 2 different types of liquidity: high resistance liquidity and low resistance liquidity. High resistance liquidity is a recent liquidity sweep that is causing a current move. Okay, so let's say we have an uptrend right here, and then boom, we get a liquidity sweep, and then boom, we're moving down here. High resistance liquidity is going to be this high right here. Okay, because this was a recent liquidity sweep that is causing the current move down. Okay, I'm going to give the context of why we need to know these things, and why this is important for us, but I just want you guys to have the definitions first. So high resistance liquidity is a recent liquidity sweep that is causing the current move right now. Okay. And then to the downside, we'll show an example of that. Boom, we have a downtrend and then bow. So this low right here, and again, draws on liquidity, or sorry, liquidity lies above highs and below lows, right? So we have liquidity up here, liquidity up here. Okay, we have liquidity right here. We have liquidity right here. Okay, there's 2 different types of liquidity. Above this high is high resistance liquidity. Below this low is high resistance liquidity. Why? Because it's the boom move or the liquidity sweep that is causing the current move right now, right? So this move down is a liquidity sweep that caused price or is causing price to move up right now. And this liquidity sweep to the upside is causing price to move down right now. So that means that above this high right now, this is high resistance liquidity. And below this low right now, below this low right now is high resistance liquidity. Now, high resistance liquidity, we want to trade away from high resistance liquidity. Why? Because it's causing the current move, right? Even though this is a high, and even though this is a low, and yes, it is technically a draw on liquidity, and technically there could be orders to be filled underneath here or above this high. Right now, this move that went up to sweep out this liquidity right here, it's causing this move down. So we want to be trading away from that, right? Because we're using the liquidity from this move up to push price down. We want to always trade away from high resistance liquidity. Same thing here. Let's say we're at this point in time. Let's say we're at this point in time in price, right? Price just came down. We swept out these lows, and then boom, we get a big leg up. And again, I haven't introduced the other confluences to you guys yet, but we see all the confluences, and we know that price is going to reverse and move higher, right? Do we want to try and take trades down towards this low? Probably not, because this low, even though there is some potential, that there are orders to be filled here, this low is what caused this move up. So this is high resistance liquidity. We want to be trading away from high resistance liquidity. okay? And we want to be trading towards low resistance liquidity. Okay, so what is low resistance liquidity? Low resistance liquidity, and I'll give you guys a second to write this out as the definition. Low resistance liquidity is stacked up draws on liquidity that is easy for price. So low resistance for price to push towards, to take out. So in both of these examples, what would be low resistance liquidity? It would be this low, 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 because these lows are all stacked up, nice and easy, right? For price to be able to just go down and take out all of these lows. All of these lows are stacked up. Let me redraw both of these real quick, just so you guys can get a better view. Low resistance liquidity is stacked up highs or lows, okay? That's in the opposite direction of high resistance liquidity. That's easy for price to push towards to take out. Okay, so again, let me do an uptrend here. Oops. Jeez, dude. Why is my drawing horrible? Boom, awesome. Now that's some juicy low resistance liquidity, right? So let's say on this leg up, we end up sweeping out the liquidity to the upside, and then boom, we get all the confluences necessary for us to identify, hey, this was a liquidity sweep. Now what does that make this? This is high resistance liquidity because it's making the move down, okay? It's the current sweep of liquidity. And then all of these lows right here are low resistance liquidity. So price is going to be super easy for price to want to go down and take out this low, this low, this low, this low, and this low. Okay, we trade away from high resistance liquidity and towards low resistance liquidity. Then same thing in the opposite direction. And I know right now you're probably like, what are you talking about? I just need you guys to get these definitions so that later on we can use them to our advantage. Okay, oops, damn it, whatever. Let's just leave it at that. So cool, let's say we're in a downtrend, price comes down, we sweep out this low, and then we start changing direction. What does that now make this low? High resistance liquidity. What does that make all of these highs? Low resistance liquidity, because they're all stacked up and there's a whole bunch of orders. Why do we even want to be able to identify low resistance liquidity in the first place? Because there's a bunch of orders sitting above these highs, these highs, these highs, these highs, these highs, these highs. Why is it beneficial for us to be able to identify low resistance draws and liquidity? Well, because if we're filling a bunch of our orders underneath these lows, we need to find a spot for these orders to be finished at, right? We need to be able to find a place where these orders, where we can end up selling off these orders, right? If we enter a massive amount of buy positions right here, we have to find people, right, that we can sell to. So again, let's put this into perspective. As we start pushing higher and higher, what do we know sits above highs? People that are willing to press buy. It's all coming full circle now. So we filled a massive amount of buy orders right here. When we come above this high, what does that give us the opportunity to do? Sell some of our shares. When we push above this high, what does that give us the opportunity to do? Sell some of our shares. When we push above this high, what does that give us the opportunity to do? Sell some of our shares. Because all of these people are willing to buy as we push above these highs.
So we need to match our highs with the order book.
Okay,
Go
so
away from
high resistance liquidity is the recent liquidity sweep that is causing the current move. And low resistance liquidity is stacked up liquidity that is easy for price to push towards, to take out. Because again, the more orders, the better. okay? And we trade away from high resistance liquidity and towards low resistance liquidity. Now, this is step one of identifying where the market is going to go. And there's a lot of steps that are required after this. I want to show you guys a couple examples of low resistance draws on liquidity and high resistance draws on liquidity. So we'll go ahead and do that right now. Let's see here. Let me pull up the 4-hour time frame. I mean, yeah, this is a good example. Right now, right here is a good example. So let's look again, low resistance liquidity. It literally paints itself perfectly here. We have a low right here. Then we have another 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 low right here. What did price end up doing? It wanted to trade towards after sweeping out this high right here. What did price do? Sweep liquidity, and then where did it want to trade towards? Low resistance, stacked up liquidity. Low resistance liquidity, low resistance liquidity, low resistance liquidity, low resistance liquidity. All of these lows are just stacked up, and price, boom, targeted them. And in the same breath, we were trading away from this high. Cool. Cool. Let's show you guys another example of that. Oh, man. Oh. Let's see here. Let's find another example. Yeah, this is a good example right here. We have low resistance liquidity, low resistance liquidity, low resistance liquidity. Look, just look at all of these lows. And low resistance liquidity, it's easy. A good way to remember it is just by calling it like trend line liquidity, okay? Because most of the time, right, it's just like, again, just like I was showing you guys in an uptrend, right? It's literally just like trend line liquidity, right? It's just like all of these lows that are stacked up, right? Price is going to want to actively seek out all of those lows, okay? I'm trying to find an example to the upside, but we've been moving so freaking, I mean, we're also on a very bullish index, so it's hard to find an example of low resistance liquidity to the upside on a high time frame, but let me see if I can find one.
That day was nuts. I stayed out of the trades like 4 days in a row that week. Oh.
Yeah, it's hard to find when we're on an index that moves up and to the right. Yeah, it would have to be on the lower time frames. I mean, this is decent. Damn, I might have just lost it by doing that. I fully lost it by doing that. Oh, wait, here we go. This is a good example on the high time frame.
Oh, yeah, there you go.
So, again, it doesn't happen too often in the opposite direction, at least on the high time frames on NASDAQ and the S&P 500, because these are indexes, US indexes that, you know, stocks move up. So, and these indexes move up. So on the high time frame, there's not going to be many examples of low resistance liquidity, low resistance highs that actively are just all the time getting swept out and then price moving down, because these are indexes, right? What do? They typically go up over the course of time. But this is a good example as we were in this little like yearly down or like year retracement of 2022. We have these high time frame highs. So look, right? We have boom, trend line liquidity or low resistance stacked up highs all within here. What did price want to do? Actively seek it out. And then what did that also cause price to do? Now we have, then what did price want to do once we took out all of this low resistance liquidity? We swept all of it out. Boom. Now this is high resistance liquidity because we start the move down now. Okay. We start the move down and then boom, we move lower. Okay. But that's all that we need to know about liquidity for now. Okay, I'm going to introduce all of these confluences to you guys separately and individually, and then we're slowly going to start putting them together on how we can actually like create this strategy to be able to make highly probable decisions within the markets. And again, if you guys just watch that and you're like, liquidity sweeps are awesome, can't wait to use them and make $1 billion. You're not going to be able to do that with just liquidity sweeps, okay? You're going to fucking suck and you're going to lose money. So let's hold the horses. Okay, the next confluence, so liquidity sweeps, awesome, liquidity. Took some time, but we covered it. The next thing that I want to cover is break of structure, okay? And break of structure, along with a couple other confluences that I'm going to introduce, is a confluence that helps us identify the current trend in the market, okay? So again, when we think about uptrends, how do they move in higher highs and higher lows? In downtrends, how do they move in lower highs and lower lows? Break of structure helps us identify the changing of these trends, okay? Break of structure, along with a couple other confluences that I'm going to introduce today, help us identify the change in order flow or the change in trend that helps us, again, identify when a liquidity sweep is actually happening. And how are we able to tell if that liquidity sweep is actually happening? Because we're going to see the trend change, right? So we're going to be able to see, okay, we pushed above a high. We know that highs have a potential for us to be able to, whatever, when we push above it, fill orders for us to go lower. How do we know that orders got filled? Well, we're going to want to for a change in trend, a change in the previously bullish trend into a bearish trend. And break of structure is a confluence that helps us do that. So let's get into break of structure. And believe it or freaking not, guys, I know what I'm talking to you guys about right now. Maybe you guys have already seen 100 freaking TJR videos on this. Hopefully, I don't think I've talked about high resistance and low resistance liquidity in any YouTube videos before, so that's already something new for you guys. But also, a lot of you guys are marking out these confluences incorrectly, and it's causing you guys to suck at trading. Again, why are you guys here? Because you guys are unprofitable. So again, just staying like on top of this and just like actually watching how I'm marking out these things, it's going to be beneficial for you guys because, you know, you may have thought that you got it 100% right, but you've just been marking it out completely wrong this entire time. So let me chug this and then we can get into break of structure. Also, boys, we've been going for an hour 30 so far. We're not even we're not even close to finishing. Okay, let's get into it. Oh man, I'm back. Break of structure. Oh, how do we identify breaks of structure? Well, it's just a trend change. So again, if we think back to our uptrends and our downtrends, all right, this is pretty much how they look, right? So if I'm in an uptrend, how would the trend change? Okay, what would be a break of this trend? Well, if uptrends move in higher highs and higher lows, what would price have to do to change this trend? It would have to make a lower low and a lower high, right? Because that would turn it into a downtrend, right? So as we're in an uptrend, what would price have to do in order to change the current trend? It would have to make a lower low and a lower high. All right. And in a downtrend, what would price have to do in order to break the current trend that we were in? It would have to make a higher high and then a higher low, right? And that's all that breakup structure is. It's literally just breaking and changing the current trend that we are in. Okay, so now order flow and trends, it's the exact same shit. Okay, sometimes I'll say we're in bullish order flow just to sound like fucking Einstein. It just means that we're in an uptrend. Or I'll say that, oh, we just broke bearish order flow, or we invalidated bearish order flow. That means, okay, we changed, we broke out of the bearish trend. Okay. Now, breakup structure helps us identify valid liquidity sweeps, because you'll actually notice that, like, what do I have right here? Like, what is this right here? As we've drawn a breakup structure, what did we just naturally end up drawing as well? We ended up naturally drawing a liquidity sweep. We pushed underneath a low and then we changed direction to the upside, right? So again, breaks of structure helps us identify liquidity sweeps. Why? Because again, when we move above highs, there's a potential for price to be able to fill a bunch of orders. How do we know that orders get filled? By seeing the trend change. So how can breakup structure help us identify actual real liquidity sweeps? Well, we have to wait for a breakup structure to see if the trend has actually changed, to see if these orders were even filled up here. Okay, and without a breakup structure or without a change in trend, then the trend is just continuing, and the orders above all these highs in the uptrend, they didn't need to get filled, or price didn't want to move off of them. And again, that's why we can't just press sell every time we push above a high, or buy every time we push below a low, because again, like, uptrends and downtrends, they are a real thing, and for the most part, they stay true to themselves. And if you were just to press buy every single time a low got pushed underneath, you would lose a shit ton of money, because price would come down, take out this low. Price would come down, take out this low, and you're just losing every single time until maybe you end up winning, right? So we need breakup structure to help us be able to, okay, we pushed above a high, and then awesome, we're changing the current trend that we're in. That's confirming. Breakup structure is a confirmation confluence that orders have actually been filled and that the trend is changing. Okay. Breakup structure is simple. We identify the current trend. Are we in an uptrend or are we in a downtrend? Then we identify the high or the low needed to break for the trend to change. So we sit here and we say, okay, within an uptrend, we're looking at the most recent low. And within a downtrend, we're looking at the most recent high. Because again, trends move in higher highs and higher lows, or lower highs and lower lows. So in order for this uptrend to break, we would need to close underneath the most recent low. And in order for this downtrend to break, we would need to close above the most recent high. Okay, and that's literally all it is to it. We identify the current trend, then we wait and we're monitoring the most recent high or the most recent high or the most recent low within the current trend. So when we're in an uptrend, what are we looking for? We're looking for lows to get closed underneath, or we're looking for the most recent low to get closed underneath. And when we're in a downtrend, what are we looking for? We're looking for the most recent high to get closed above, to show what? A change in trend. Okay, now let's show you guys this on the charts, because it's one thing to draw it out, but it's another thing to actually see it on the candles. let's just show you guys on the weekly time frame for now. The weekly looks ugly. Let's do. Daily looks ugly too. 1 hour. See if the 1 hour gives us anything good or a good example of this. Sure, this is a good example. So let's say that we're right here in price. How do we identify breakup structure? Again, this doesn't have anything to do with strategy right now. This is just helping us learn and identify breakup structure, okay? So I don't want you guys like looking into this and being like, where's the entry? Like, shut up, okay? We're just here to be able to identify the trend, identify the highs and lows, and then identify the breakup structure.
All right.
So right now, at this current point in time, what trend are we in? In order to identify breakup structure, we have to do what? Identify the trend, identify the most recent high or the most recent low, and then we need to close either above that most recent high or close below that most recent low. So what is the current trend? Right now, you guys are probably trying to map this shit out. I'll show you guys the easiest way to be able to identify what trend we are in. You just look at the most recent high and low that has been put in. Okay, so not just the most recent, or I mean, yeah, you can look at the most recent high and low. So look, where's the most recent high? Up here, move up, then move down, boom. And then you look at the most recent low, move down, then move up. And then you compare it, okay, to the past ones. Okay, well, we see, boom, the previous most recent low is right here, and then the previous most recent high was up here. Or right here. Move up, then move down. Okay. So what's the current trend that we're in? We're in a downtrend. Why? We don't give a fuck about this high because we have a low, then a high, then a lower low. Okay, and let's do even more research here. When did this downtrend start? Let's look to the left-hand side here. When did this downtrend start?
The high point.
Let's first identify what the trend was prior to that. Well, we were in an uptrend. How did I know that? Because we have a high right here, move up, then a move down. Boom. What did price do? Closed above it. The easiest way to identify a trend is you identify the area that a trend would change, and you just look if that area is intact. So if I'm looking to see, okay, what trend are we in? I'm just looking at the most recent highs and lows of whatever area that we're in. So like if we're right here, and I say, okay, what trend are we in? I'm looking at, boom, the most recent highs and the most recent lows. And I see, okay, did we close above a high or did we close underneath a low? Okay, we closed underneath a low. So what are we in? We're in a downtrend. So we didn't close above this high. We're underneath this low. And then let's play this a little bit. Boom. Now let's do that. Let's do that again. What trend are we in? Okay, I'll mark out the lows and I'll mark out the most recent highs that we have. Okay, we have a low right here. Did this low get closed underneath? No. Did this high get closed above? Yes. Awesome. Now we're in an uptrend. Again, these confluences mean absolutely fucking nothing by themselves. So if you guys just press buy when we go into an uptrend, you guys are not going to make any money and you guys are going to lose a lot of money. And if you guys just press sell when we go into a downtrend, like this, for example, like if you guys just press sell right when we close underneath this low right here, maybe you guys would be in profit for a little bit, but then after that, boom, you guys are getting crushed, right? So again, these confluences mean nothing without context. Okay, and when they're not put together, they're literally useless, just like how we mentioned before. let's just go through. Gross. Sorry. Okay. What we'll do is we'll literally just go through price action, and we'll start at one point, and then we'll just identify the breaks of structure as price goes on. Okay, so let's just go ahead and this will give us a great opportunity to show you guys what break of structure is and what break of structure isn't. Okay, let's go. Let me find a good place to get this going at. I want to find a good example of like just absolute madness going on. This is good. And this will prove my point of using break of structure just alone and by itself is absolutely useless. So let's go ahead and let's just start right here. On this candlestick, what is the current trend that we're in? We're in an uptrend. How do I know that? Because the most recent high got closed above. Boom. And the most recent low is all the way down here. And we're definitely not underneath that low, and we're definitely above this high. So boom, we're in an uptrend. So when we're in an uptrend, let's say that we're waiting for a liquidity sweep and we're waiting for a break of structure. Let's just say that we're waiting for a break of structure. So we know that we're in an uptrend. So we don't care about the highs, right? Because when we're in an uptrend, what starts a break of structure to the downside? When we close underneath the most recent low, right? So we don't care about the highs in an uptrend, okay? We care about the lows, specifically when we're talking about break of structure. So we're looking at the lows. Well, on this candlestick right here, the most recent low is down here. Move down, then move up, the lowest point of those two candles. Beautiful. Then we make this bullish candlestick, so awesome. Now this is the most recent low. Okay, price moves up, we have a higher high, and then, oh my goodness. Look at this right here. Price comes down, and we actually make a lower low. Is this a break of structure? No, this is not a break of structure. So this is super important, and you guys need to get this. A break of structure is only when the candlestick body closes underneath the low or above the high. So we need this entire black candlestick body to completely go underneath this low. So just because price comes down and puts its little candlestick wick underneath this low doesn't mean that that's a break of structure. Okay, so when this happens, what does that mean? Nothing. We're still in an uptrend. So what are we still doing? We're still identifying the lows. And once this candlestick closes, what does that actually do? Move down, then a move up. Lowest point of those two candles. Boom, this is now our new low. Once again, we get a move down, then a move up. Boom, now this is the new low. And then does this candle right here break structure? Not quite. It's right in line with this line. It doesn't close underneath it just yet. This candlestick, boom. We finally break the uptrend. So now what are we in? We're in a downtrend. So now what are the only ones that we're trying to monitor when we're trying to look for break of structure? Now we're only looking at the highs. So where's the most recent high? Boom, all the way up here. Price goes down, move up, then a move down. Awesome, now this is the high that we're monitoring. And then boom, now what are we in? Now we're in an uptrend. Awesome. So now what do we want to monitor? We want to monitor the lows. Where's our most recent low? Right here. Move down, then a move up. Boom, the very next candlestick. What do we end up doing? We end up changing direction again. Now we're in a downtrend. So now you can kind of see how if we're just taking trades off of just break of structure, you would get burned. However, break of structure is a very useful confluence that you guys will see is very beneficial and can make us a lot of money. Okay, it just has to be used in the right context. So now we're in a downtrend on this candlestick closure. So now what are we doing? We're monitoring the highs, and then boom, now we're in an uptrend. So now what are we doing? We're monitoring the lows. Now we have a move down, then a move up. Now we're looking at this is the most recent low, then a move down, then a move up. Now this is the most recent low. Then we come down and we toss a wick underneath this low. Is that a break of structure? No, not yet. Then we get this candlestick closure. Is that a break of structure? No, not yet. Then we get this candlestick closure underneath the most recent low. Is that a break of structure? Yes, it finally is. So now, what are we in? We're in a downtrend. This is a good example of how people identify highs and lows incorrectly. I want you guys to look at this area right here. We have a move up, then a move down, then a move down, then a move down, then a move down, right? Where is the high of this candlestick group right here? I'll give you guys some time to answer it, to take a guess. Where is the high? If you guys said right here, you guys are wrong. Why are you wrong? Because this is a move down, then a move down, then another move down, then another move down.
What's going on?
So this is essentially what you guys marked out as a high.
It's live right now.
Do
In
we
class.
see any peak? Do we see any
What was
top of that?
I'm live right now in class.
No. A high has to consist of a move up, then a move down. And then we take the highest point of those two candlesticks. So this is a perfect time to introduce that.
Look at the Discord
So
chat,
where's the
Dylan. I
high
muted you. I'm live,
of
brother.
this candlestick group? Move up, then a move down, boom. This
Man, left.
is the high because we have a blue candle, then a black candle, and the highest point of those two candlesticks is right here. Okay. Cool. Cool. So I think we've established how to identify highs and lows, how to identify trends, how to identify break of structures within trends. We've also talked about how to identify where liquidity lies, how to identify draws on liquidity, the different types of liquidity. We are making progress, people. We're making progress. We're not there quite yet, but we are making progress. Okay? So we know how to identify trends. We know how to show break of structure. Okay. Cool. So, next thing that I want to introduce, is fair value gaps. Okay, fair value gaps are the second most important confluence that I'm going to be discussing. Okay, price is always either looking to take out draws on liquidity or fill imbalances in the market. And fair value gaps are imbalances in the market. Okay. Price moves from internal liquidity to external liquidity. Internal liquidity is imbalances and continuation confluences, and external liquidity is highs and lows, the liquidity that you guys know and love. Okay, so internal liquidity is imbalances and continuation confluences. I'm going to introduce a couple continuation confluences to you guys. Okay, and external liquidity is literally just liquidity as we know it, highs and lows in the market. Okay. Before we get into this, I need to eat a little snack.
Find
Going
it.
hard right now, boys. See how much time we got left on here. Whew. Oh.
We're cooked, Jack.
We got a long time. It's gonna be good though. It's gonna be good. I don't know if you guys heard how many
It's expected to be another 3 hours, but he's talking to me
scrolls I
about
fucking hit on that shit, but it was a lot. Okay.
Yeah, I was surprised it came out with such a long workbook for the first day.
Ugh. All right. So, fair value gaps are imbalances in the market. It's the second most important confluence that we're going to talk about, because price is always either looking to take out draws on liquidity or fill imbalances. Okay. So let's talk about how to identify a bullish imbalance and a bearish imbalance. Okay. Okay. Wait. It's fine. All right. So let's talk about how to spot fair value gaps in the market. Fair value gaps are essentially a 3 candlestick pattern. Fair value gaps are a 3 candlestick pattern. Okay. A bullish fair value gap. Okay, and this is again, when are we trying to identify bullish fair value gaps? When we are in an uptrend. When are we trying to identify bearish fair value gaps? When we are in a downtrend. So a bullish fair value gap is identified by 3 candles. Okay, we have the first candle, we have the expansion candle, and then we have the third candle. I don't really have a name for the first or the third candle, but the second one is the expansion candle. And essentially, with these 3 candlesticks, we can see that if we understand candlestick anatomy, where, okay, right here was this candlestick open, and at some point in time, price during this candlestick's life, okay, had buy orders that pushed up to here, okay, and then also at some point in time had sell orders that pushed down to here, and then at the very end closed right here, right? So it had buy orders that pushed up to here, it had sell orders that pushed down to here, it opened right here, and it closed right here. The expansion candlestick, same situation, okay? It opened right here, it had sell orders that pushed down to here, it had buy orders that pushed all the way up to here, and then ended up closing right here. Okay, the third candlestick opened right here, had buy orders that pushed up to here, had sell orders that pushed down to here, and then ended up closing right here. Now, when we see this 3 candlestick pattern, we see a gap between the top of the first candle's wick and the bottom of the third candle's wick. That's how we identify bullish fair value gaps. from the top of the first candle's wick to the bottom of the third candle's wick. Okay, and it's the space that lies in between. And this is what we call an imbalance. Okay, it's an imbalance of price. Why is it an imbalance of price? Because when we look at the first candlestick, we know that it opened right here, and at some point in time it had buy orders that pushed it up to here, but also at the same time it had sell orders that ended up stopping it from moving higher. Okay, so there was sell orders that were stopping it from moving higher right here, and then ended up pushing price down to close right here. The next candlestick, what did it do? Boom, ripped up, okay? Whole bunch of buy orders. So, boom, sell orders stopped it from moving higher right here on the first candlestick, and then on the third candlestick, we open right here, and we had sell orders that pushed price down to this right here, and then we had buy orders that pushed it back up right here. But we had sell orders that were able to make it down to this wick right here.
I think I'm realizing why they create these
So,
bigger stocks.
with that knowledge, what does that leave us with an emptiness of,
More
an
orders
imbalance
happening.
of?
It's easier
It
to
leaves
read
us
what
with
the
an
market's gonna
imbalance
do.
of sell orders. Now you're probably saying, well, why is that the case? Well, when the buy orders push price up right here, we had sell orders that were able to push price down. But when this candlestick had the buy orders necessary to be able to get past these sell orders that lied right here, what did price do? Boom, it ripped through. There was an imbalance of sell orders. There were no sell orders within here. And that's why price was able to expand so much. That's why price was able to expand. And then we look at the third candlestick and we say, okay, sell orders were able to push price down right here to this point in time, but that's as far as they got. So we're able to mark where the sell orders stop and where the sell orders stop, and then we're able to identify the gap in price or the imbalance in price where there's a lack of sell orders. Now, how is that beneficial to us as the trader? Well, fair value gaps are continuation confluences. So let's say that we are in an uptrend and price creates one of these pockets or one of these imbalances in price where there's a lack of sell orders. What happens if price revisits this area? What does that give the market makers the opportunity to do? The second that they place any sort of buy orders, it's going to give price the opportunity to go much higher because there's a lack of sell orders within here. There's going to be no resistance to their buys. So we know that there's a lack of sell orders within here. And because there's a lack of sell orders, it gives the market makers the opportunity to place their buy orders and cause price to go higher within these gaps and within these imbalances. Now it's the same thing for a bearish fair value gap, except in the opposite direction. So we have the first candle, the expansion candle, and then the third candle. It doesn't matter what color the first candle and the third candle is, okay? Fair value gaps, they're not racist, okay? They don't see color. The only time that they see color is for the candlestick that is in between, okay? Because that identifies what fair value gap it is, right? And we're only looking for bearish fair value gaps when we're in a downtrend, and we're only looking for bullish fair value gaps when we're in an uptrend. All right? So we're in a downtrend and we get the first candle and we get sell orders that are able to push price down to here, but then buy orders that stop price from moving any lower, and then boom, price ends up closing right here. The next candle opens and then boom, we get a massive expansion to the downside. Okay, pushing price. Oh, I'm about to sneeze. Guess not. Pushing price all the way down here. Then the next candle, we open right here. We get buy orders that are able to push price up to here, but then that's as far as it goes, and then price ends up coming back down, and we actually come all the way down to here and then close right here. So what does that leave an imbalance of? From the first candlestick's bottom wick to the third candlestick's top wick. That's how we identify bearish fair value gaps. Okay, so bullish fair value gaps, it's from the first candlestick's top wick to the third candlestick's bottom wick. Bearish fair value gaps, it's from the first candlestick's bottom wick to the third candlestick's top wick. Bearish fair value gaps, what do we have an imbalance of? We have a lack of buy orders. So if we're in a downtrend and price is right here, for example, and we come back and we revisit this price range or this gap where there's an imbalance, where there is no buy orders, what does that give the market makers the opportunity to do? Fill their sell orders to push price lower. Okay. So now that we've shown drawings of that, let's show examples of it on the chart. Let's show examples of it on the chart. Let's show examples that are not fair value gaps. Let's show, what else do I want to show? How there can be multiple fair value gaps stacked on top of each other. Okay, so this is a great example right here. Again, we're not trying to put these confluences together just yet. We're just trying to be able to see them on the chart and identify them. Okay. Right here. First of all, let's go back to breaker structure. What is on this candlestick right here, this candlestick closure right here? What is the current trend that we're in? We're in a downtrend. Okay. Why? Because we close underneath this low. Okay. We close underneath the most recent low. And this is our most recent high. Up here, not closed above. This is our most recent low, closed underneath. Cool. We're in a downtrend. A good way to be able to sit here and look and identify fair value gaps in the market is literally just by looking for these expansion candles and by looking for gaps in between the candlestick wicks. So when we're identifying a bearish fair value gap, we take it from the bottom wick of the first candle to the top wick of the third candle. This is a fair value gap, a bearish fair value gap. Oh, look, there's another one right here. From the bottom wick of the first candle to the top wick of the third candle. It's a 3 candlestick pattern. First candle, second candle, third candle. First candle, second candle, third candle. Okay. Let's show an example of a bullish fair value gap. This is a good example right here. A whole bunch of them stacked up on top of each other. On this candlestick right here, what's the current trend that we're in? We're in an uptrend. Why? Because we look at the most recent highs and lows. Most recent high was closed above. Most recent low was not closed underneath. Boom. Again, we're getting better at tracking and seeing these things. So boom, we're in an uptrend. Let's identify our bullish fair value gaps. First candle's top wick to the third candle's bottom wick. This is a fair value gap. First candle's top wick to the third candle's bottom wick. This is a fair value gap. First candle's top wick to the third candle's bottom wick. This is a fair value gap. Boom. Okay. There can and there will be, as we just showed right here, the opportunity for fair value gaps to be stacked up on top of each other. like so. There can be a fair value gap right here, a fair value gap right here, and a fair value gap right here. All of them are valid, all of them can get filled, and all of them we can use to our advantage. Now again, all that I want to do right now, again, with all of these confluences is just identify them, okay? Because again, right now, and as I mentioned before, these confluences are useless without our system put in place. As we can see, right, we have our bullish fair value gap right here. Price doesn't really give a fuck about it. It doesn't do anything off of these things, right? It's useless when they're not put together, all right? Now let's show an example of what a fair value gap is not. This should kind of go without saying, but let's say we see, oh look, there's a whole bunch of bullish candles stacked on top of each other. Well, okay, is this a fair value gap? We have this high right here, and then we have an expansion candle, and then we have the third candle, and this is the low. Well, is there a gap between the high of the first candlestick and the low of the third candlestick's wick? No, they overlap. This is not a fair value gap.
It's about to open and to close. Okay.
Let's look right here. Boom. One candlestick, two candlesticks, three candlesticks. We have the high of the first candlestick, and then we have the low of the third candlestick. Is this a fair value gap? No, because the candlestick wicks overlap. There's no expansionary zone. Let's do the same thing to the downside. Show what a fair value gap is not. Okay. One bearish candlestick, two bearish candlesticks, three bearish candlesticks. Awesome. And again, the candlesticks don't all have to be the same color. This candlestick could be blue. This candlestick could be blue. Doesn't matter as long as there's the gap. And in this case, there's not. Because we're looking for a bearish fair value gap. We look at the low of this first candlestick's wick to the top of the third candlestick's wick. Oh, would you look at that? The wicks are overlapping. It's not a fair value gap. Oh, well, TJR, this is a lot of moves down. There's got to be a fair value gap within here. Okay, well then let's look. First candlestick, the bottom of the first candlestick's wick, the top of the third candlestick's wick. Oh, the wicks overlap. It's not a fair value gap. Okay. Cool. Solid. So we know how to identify draws on liquidity. We know how to identify changes in trend with break of structure. And we know how to identify fair value gaps. All three of these things are absolutely useless to us right now, but they will eventually be very useful. Just wait on it. We still have some time to go here. The next confluence that we are going to talk about is equilibrium. Equilibrium is a very simple confluence. It's another one of our continuation confluences. Okay, so what I'm going to start doing for you guys is I'm going to start grouping these confluences together. So we have the confluence that kicks everything off, which is liquidity sweep. And what does this do? It fills orders. Then when we see orders that get filled, or when we see the potential for orders to get filled, what do we want to, what do we want to look for after we see an area that orders could potentially get filled? Well, we want to see and confirm that orders were actually filled. So how do we confirm that orders were filled? Well, we're going to want to see a change in the trend. How can we see a change in the trend? With break of structure. So break of structure is one of our confirmation confluences. So the first thing that we're looking for is we're just looking for orders to get filled. How do we see that happen? Through liquidity sweeps. How can we confirm that orders have been filled? By a change in trend. The one confluence that we have learned so far that helps us do that is break of structure, or short BOS. Once we've seen the potential for orders to get filled, and once we've confirmed that orders have gotten filled, what's the next thing that I'm going to want to look for? I'm going to want to see that new trend that we filled orders for and confirmed that we are making, or that we broke into. I want to see that new trend continue. So the next type of confluence that you guys just learned, which is a fair value gap, is a continuation confluence. And that comes in the form of fair value gaps and equilibrium, which you guys are going to learn right now. And this is slowly but surely going to scale into how we are able to execute and actually find trades in this very difficult market. Okay, so this is slowly but surely building out our strategy. I know you're probably like, where the fuck is this going right now? Trust me, we are slowly but surely building out our strategy. And hopefully you guys can see that we're not using like, oh yeah, the slow moving average and the exponential moving average crossed over and we're just blindly pressing buy. No, we're literally letting price tell us, hey, we have the opportunity to fill orders. Hey, orders have been filled because the trend changed. Hey, that trend is going to continue in this direction. You should probably enter. We're letting price tell us when to enter, not just off of hopes and dreams because an indicator told us to. Okay.
That's the workbook?
So,
Yeah.
the next thing that we're going to talk about is equilibrium. It's one of our continuation confluences. It's a super simple confluence, and it helps us, again, look and see the continuation of trends. So again, when we're looking to mark this out, let me make this bigger for a second. When we're looking to mark this out, what do we have to do? We have to identify the current trend that we're in because it's a continuation confluence. So we're looking for the trend that we are currently in. Again, a good way to do these things. Fair value gap, what is it? A continuation confluence. So if we're in an uptrend, then what are we going to want to look for? We're going to want to look for the trend to continue. So we're going to want to look for a bullish fair value gap or bullish equilibrium versus confirmation confluences. If we sweep out liquidity to the upside from a previously bullish trend and we're looking for a confirmation confluence, we're looking for the trend to confirm that we're going in the opposite direction. Okay. So continuation confluence, equilibrium, how do we identify it? How do we look for it in the market? Well, we first identify the trend that we're in. So if we're in an uptrend, awesome, higher highs and higher lows. If we're in a downtrend, awesome, lower highs and lower lows. How do we identify it? When identifying bullish equilibrium, we take our handy dandy Gann box here. I'll show you guys my settings on this in a second. From the most recent low up to the most recent high that has been made in the uptrend. Okay, this is the Gann box tool. I'm going to go ahead and give you guys some time to copy my settings on this while I eat a string cheese because I'm hungry. Just been slowly but surely munching as this has been going on. But this is the Gann box. You guys can copy my settings for this.
I put the workbook in the Discord if you want to check that out. Preferably, I don't really have it set up for privacy yet, so it'd be nice if you didn't come in here and microphone blast me, but the workbook's in there for you.
Whew. All right. Now that you guys have those settings copied, again, we take it from, if we're in an uptrend and we're looking for a bullish equilibrium, we take it from the most recent low up to the most recent high that was made. And all that we're looking for price to do is come down to the equilibrium of the most recent low and the most recent high. And we're looking for price to come down to fill or come underneath this line. And this pretty much represents a premium and a discount. So again, if we think about the market makers, they want the best price possible. So if and when price is in an uptrend and price ends up coming down into a discounted price range within an uptrend, that to the market makers, again, if they want to continue this uptrend, is going to be a good time to add to those buy orders to continue to push price higher. Why? Because it's a discounted price range. It's like going to the store and seeing your favorite food for 50% off, right? It's at a discount. You're probably going to want to buy some. It's a super simple confluence. It's just showing where price is at a discounted price range at. Okay, so for bullish equilibrium, we take it from the most recent low up to the most recent high that gets made. And then all that we want to see price do is come down into equilibrium underneath this line right here, which represents a discounted price range. And then if the market makers want to send it higher, we will see bullish confirmations out of that, and then price will move higher to continue, because again, it's a continuation confluence, to continue the uptrend that we are currently in. Okay? Now, for a downtrend, it's the same thing. For bearish equilibrium, we take it from the most recent high down to the most recent low. Okay? So if we're in a downtrend and we're looking for this trend to continue to the downside, this is one of the confluences that we can use to be able to identify a good point in which, as we're coming up to make another lower high, that price would likely reverse at, because if price comes into up here, this is a premium range. You're probably saying premium, why would the market makers want to buy at a premium? Well, dumbass, they're not buying at a premium because we're in a downtrend. So they're actually shorting in a premium, and that's good. When you press sell in a premium, that's good. And they fill their sell orders in at a premium price range, that's good for them because, again, it's inversed, right?
Well,
and then if they, again, as price comes into the premium price range in the downtrend, that's a good spot for them to look to short the market. They short the market, and again, their massive orders cause price to move lower and continue the bearish trend that we are in. Okay, so equilibrium, how do we identify it? From the most recent low in the uptrend to the most recent high in the uptrend, and then we wait for price to come into the discounted price range, which is underneath this line right here. And then we look for buy orders to get filled. How do buy orders get filled? We just look for moves up. Boom, price is going to move higher. And then for the downtrend, again, we mark it out from the most recent high down to the most recent low for us to be able to identify the premium price range. And we know that the market makers are going to want to short in a premium price range to move price lower and to continue the downtrend down. Okay. And again, this is literally as simple as market makers always want the best prices. and they are going to get the best prices for themselves. So let's show examples of this now. We can literally pull this up anywhere. Again, this used on its own is absolutely useless. So again, it's like, okay, you can identify the current trend that we're in, and then you can try and draw out equilibrium, but pressing short when price comes into a premium price range is not going to make you any money, and pressing buy when price comes into a discounted price range isn't going to make you any money, okay? What is going to make you money is by following the systematic strategy that we have built out while putting all of these confluences together to actually make sense of why price is moving. All right, so let's just show an example right now. Right here, for example, on the daily time frame, again, these confluences show up on every single time frame. It's applicable to every single time frame. What is the current trend that we are in? Let's just, fuck it. Let's just look at this, like the current candlestick that we're on. What is the current trend that we're in? We're in a downtrend. How do I know that? Because I look at the most recent low. Okay, move down, then move up. Boom. We close underneath that. Move down, then move up. Boom. Close underneath that. Okay, we're in a downtrend. When did we start the downtrend? Right here. So let's show the example. Again, when we're in a downtrend, how do we draw out equilibrium? We take it from the most recent high down to the most recent low. Boom, this is our equilibrium. What do we see price do? Bring it into a lower time frame for you guys. Boom, we come from the high down to the low. We push into the premium price range. And then we fill sell orders to push price lower. Show a bullish example. This is a good example right here. Let's look at this current standpoint in price. What trend are we in? We are in an uptrend. How do we know? Because I look at the most recent high and the most recent low. The most recent high got closed above, so we're in an uptrend. How do we identify equilibrium? We take it from the most recent, how do we identify equilibrium in an uptrend? We take it from the most recent low up to the most recent high. Okay, and this is a good example of equilibrium not getting hit. So look, from the most recent low up to the most recent high, price does not come down and fill equilibrium. So this would be an example of equilibrium not getting hit. So again, right now I haven't told you guys about entries and everything, but this would not suffice to be able to give us an entry. Let's find an example where it actually does give us an entry to the upside so that you guys can actually see one. Let's find an example. Just want to find like a clean uptrend. That's not clean. Give me a clean uptrend. Still nothing. I don't think that hits equilibrium. Good enough. Okay. Right here, what is the current trend? We're in an uptrend because we have a move up, then a move down. This is the most recent high. We closed above that. Awesome. Okay. Again, all of these confluences, they're going to make sense when we put them together. Right now, it's just identifying them on the chart. Okay. We're in an uptrend. You can identify it by the breakup structure. We have a move down, then a move up. When we're in an uptrend, we take equilibrium from the most recent low up to the most recent high. Okay, so move down, then a move up, then a move down. Boom, we take it from this low up to this high. Price comes down into the discounted price range. This is a discount, so the market makers are looking to buy in the discount to continue the uptrend higher. Awesome. That's an example of bullish equilibrium. Now, we've covered liquidity sweeps, break of structure, fair value gaps, and equilibrium. We have a couple more things that we need to cover. We need to cover inverse fair value gaps, which are the same thing as break of structure. We need to cover SMT divergence. We need to cover 79% extensions. And then from there, we will have pretty much covered every single confluence necessary for us to be able to move. So let's go back. I'm kind of mad because I deleted that cheat sheet that I had made. I'm just going to put it up here on the weekly, or I'll put it on Bitcoin all the way up here so that it just never disappears. So first thing that we're looking for is just orders to potentially get filled. How do we see that? Through draws on liquidity or highs and lows. Okay, so we mark out the highs and lows. From there, when we hit the highs and lows, what are we looking for? We are looking for price to change trend. We're looking for those orders to confirm that they have been filled. So look for change in trend to confirm that orders have been filled. And how do we do that? Via break of structure. Come on, dude. Oh my gosh. Bro. Okay, via break of structure. And now I'm about to teach you guys inverse fair value gaps. And I'm also going to teach you guys 79% extensions. There we go. Okay. So again, we're looking for orders to potentially get filled. How do we do that? By identifying draws on liquidity above highs and below lows. Once those highs and lows have been hit, we're looking for a change in trend to confirm that orders have been filled. How can we confirm that orders have been filled? By looking at a change in the trend. How can we see change in trend? Through break of structure, inverse fair value gaps, or 79% extensions. Awesome. And then once we see that, we're looking for continuation of that trend. And how do we see continuation of those trends? Well, we just told you guys through fair value gaps and equilibriums. Awesome. And then SMT divergence is kind of in between these two. But again, we're slowly but surely building out our strategy here. So the next thing that I'm going to teach you guys is inverse fair value gaps. Inverse fair value gaps are just like fair value gaps, except the opposite. So you're probably saying, what? What the fuck does that mean? Well, the first thing that we want to sit here and do is just think about, what does a fair value gap show us? A fair value gap shows us a continuation of the current trend that we're in. So what happens when, this is a good example right here, let's look at the current trend that we're in, right? What is the current trend that we're in? We're in a downtrend. Why? Because we have the most recent high up here, that hasn't been closed above, and the most recent low right here, and that's been closed underneath. Awesome, we're in a downtrend. And oh, would you look at that? We have a bearish fair value gap. We take the first candle's bottom wick down to the third candle's top wick. Okay. Now, what do we know about fair value gaps? Well, price is supposed to go into this imbalance price range, fill sell orders, and then continue the downtrend out of this, right? That's how fair value gaps should look. When we get a candlestick that closes above our fair value gap, what does that do?
Yeah,
It does two things.
He's trying to cover the full scope. I think,
that fair value gap.
He's given us a couple things that I haven't seen on his YouTubes, but
it creates a
goes over a lot of
fair value gap.
Full scope here, I'm thinking. So
okay, so this right here is again a imbalance price range.
And then this way you get it all in one place.
If this downtrend were to continue, and if this downtrend were to be valid, price should have came up, filled this gap, and then moved lower, right? But that's not what price did. Price came up and closed well above that fair value gap, invalidating this gap right here. And in turn, invalidating the bearish fair value gap and creating a inverse fair value gap, telling us that, hey, this bearish trend is not looking to continue. And if we know that the trend is no longer going to continue, what does that tell us? That tells us that the trend is going to change. So it's another way, inverse fair value gaps are another way of us being able to identify changes in trend. Okay.
Yeah, I have the
because
VIP,
if
so
this
I have
fair
the
value
after
gap
hours
were
as
valid,
well.
and if the downtrend were still valid, it would have gotten filled and it would have continued lower. However, the trend got invalidated because
Plus he's got
this fair value gap,
I guess, coming in. I've never
didn't
even
get
heard
filled
of.
and didn't get respected, and instead it got closed above, in turn invalidating the downtrend.
I'm still under
And
suspicion
now,
that this
what
first
does
day
that
is
tell us?
pre-recorded.
That's actually a
But
confirmation
good
confluence
information.
that the trend has changed and we can potentially move higher. So an inverse fair value gap is a fair value gap that gets invalidated, okay, and we can use that, and we use it the same way that we use a break of structure to tell us that the trend has changed. That's a bullish inverse fair value gap because we have previously a bearish fair value gap that then gets invalidated. So what does that make that inverse fair value gap? It makes it a bullish inverse fair value gap because, again, this fair value gap was supposed to show a bearish continuation, but it was unable to. So what does that tell us about price? It's going to move higher now. Let's show an example of this to the upside, or sorry, to the downside. Well, let's look right here. We have a bullish fair value gap. From the first candle's top wick to the third candle's bottom wick, there's a gap in between the two. Awesome. Ideally, we would see price come down, fill the gap, and then push higher, which initially it did, but did it push past this high? No, it didn't continue the uptrend. The uptrend would have been high, low, higher low, higher high, but that didn't happen. Instead, what did price do? It invalidated the bullish fair value gap, saying that this bullish fair value gap is no longer valid. And in turn, because the bullish fair value gap is no longer valid, the bullish trend is no longer valid. And what does that then start? A downtrend. And on top of that, what do we also have at the same time when this candlestick closes? We actually have a break of structure to the downside as well. Move down, then a move up. The current trend that we are in an uptrend. When this candlestick closes underneath this low and underneath this gap, that is 1,000,000% for 100% certain, telling us the trend has changed and we are now in a downtrend. Something I do want to preface to you guys. So again, now we know how to identify inverse fair value gaps. Something that I want to show you guys though, this is super important. Let me find an example of this happening.
How long you been trading for, Devin?
This is a good example. So, whew, man, we've been going for a while, man. Let's look at price action right here. Okay. Let's say that we're, actually, no, let's not use that. Let's use this. No, that's still not good. Okay, yeah, this is good enough. I'll find more examples as well. But okay, let's look at price action right here. What's the current trend that we're in? We're in a downtrend, right? We identified the most recent low and the most recent high. The most recent high hasn't been closed above. The most recent low has been closed underneath. We're in a downtrend, right? Lower lows and lower highs. Cool. Let's identify the fair value gaps that we have. Boom. First candle's bottom wick to the third candle's top wick. And then look, we have another fair value gap right here. First candle's bottom wick to the third candle's top wick. When we have, this applies to, this is for fair value gaps and for inverse fair value gaps. This is super important. Okay. Right now, the current trend, we're in a downtrend. We have two fair value gaps that are stacked up on top of each other. Okay, and there could even be another one on top. As long as it's just, boom, bearish candles all lined up, as long as they're stacked up on top of each other like this. Okay, and I'll show you guys examples in to the upside as well. All right. When we invalidate this fair value gap right here, when this candlestick closes above it, question, are we now in an uptrend? Because now this fair value gap is invalidated. If you answered yes, you are incorrect, but that's okay because that's what I'm here to explain to you guys. That is not the case. Why? Because we have another fair value gap on top of it that price could fill and then end up moving lower. Okay, this downtrend is still intact because just because price didn't want to fill this fair value gap doesn't mean that price can't fill this gap and then go lower and continue this downtrend. That happens all the time. So when we have fair value gaps that are stacked on top of each other and we're looking for an inverse fair value gap, we need to wait for the top gap to get invalidated for us to confirm that the fair value gaps are inversed. So when this candlestick closes above this fair value gap, all that it means is that this fair value gap is invalid, but we have another one on top of it that very well could be valid, and that price could, boom, move down from here. And the only time that we can say, okay, now the trend is actually invalidated is once we have invalidated the top gap of the stack of gaps that we have, which is on this candlestick closure. And then as we can see, price ends up moving higher. Now you're probably saying, okay, well, we have these gaps right here. What about the gaps that are right here and the gaps that are right here?
They're not gaps.
This isn't a gap. Do we have to wait for these ones to be invalidated? No. We don't have to wait for these ones
That's
to be
the plan,
invalidated. Why?
I'm learning.
Because we've already
Just
had
last
a
week, I
retrace up
was proud of
and then
myself,
a move
man.
down following
Slowed
that.
it down a lot.
So these fair value gaps, this is super, super important that I need you guys to remember. These fair value gaps, this fair value gap has already been balanced out because we have made a retrace and then moved lower after it. These fair value gaps are no longer valid for us to look for shorts on. So even when price comes up here, this fair value gap means nothing. Why? Because we already moved up, filled a gap, and then moved lower. Meaning that if price wanted to fill this gap, it would have done it on this move up, but it didn't need to and it didn't want to. So this fair value gap is useless now. And once we get the reaction out of this gap, this fair value gap is useless now. So now in this downtrend, there are only two gaps that are useful to us, not only to look for shorts, but also to look for change in direction to the upside for. This is so important, and so many people fuck this up when talking about fair value gaps. Everything from this high and above has been balanced out because there's already been a retrace that has been made. Because this retrace was made and then we moved lower off of it. Okay, so now we have both of these gaps. Price comes up and closes above this one. That invalidates this gap, but it doesn't invalidate the fact that we could still push lower here because we have this gap stacked on top of it. The second that we close above this gap, we invalidate this entire imbalance range, and we invalidate and we change the entire downtrend that we were in. Because if price wanted to continue the downtrend, it would have either filled this gap and continued down, or it would have filled this gap and continued down, but it didn't. So we get the change in trend on this candlestick closure. And again, this is why I'm teaching you guys this, because this gives us a significant advantage over if we were just to wait for a change of trend, and if we were only limited to break of structure, then we would have had to wait for this high to get closed above on this candlestick. Instead, we get the advantage of being able to see, oh, this bearish fair value gap got invalidated on this candlestick closure. That puts us, boom, several ticks ahead of being able to identify the trend change. I'm going to show you guys another example of this because I know that this can be confusing. Once we end up inversing that fair value gap, what trend are we in? We'll use this as an example. We're in an uptrend. Awesome. So if we're in an uptrend, whatever, let's say we're looking to identify fair value gaps. We have a bullish fair value gap right here. We have a bullish fair value gap right here. Notice we're getting a stack of fair value gaps. We get a bullish fair value gap right here. Boom. Look here. Price comes down, fills this fair value gap, and the second that we push up and we push past this high, confirming that, hey, we came down and we filled this imbalanced price range and we are continuing the trend higher. The second that we get that continuation, we are literally, that is price telling us that all that price wanted to do was imbalance this price range. So now, from here on out, this fair value gap means nothing to us. This fair value gap means nothing to us. This fair value gap means nothing to us because everything from this low and underneath has been balanced out. Because if price wanted to balance out price down here, it would have pushed down here, but it didn't. So this is no longer a valid fair value gap. This is no longer a valid fair value gap. Okay. I see so many people make this mistake where they will see this fair value gap get filled, and then we have another gap right here, and then we have another gap right here, and price will like move up and do its thing for so long, like all the way over here, and then it'll be like a completely different trend, and price will be coming down over here, and they'll be like, oh, look, we have a bullish fair value gap right here. No, we don't have a bullish fair value gap right here. These gaps are useless to us because if they were useful to us, then price would have used them. Price at this point of time would have came down and balanced out price action, but it didn't need to. So it told us that these gaps are useless. So we delete them off of our chart the second that we get one of them filled and then push out of. All of the ones that are stacked up underneath are useless to us. So if price ends up coming back down over here at some point in time and you're like, oh, these fair value gaps haven't been hit yet, you're an idiot. And so many people do that. Finally, we're starting to get into some of the advanced shit that maybe you guys haven't heard on a YouTube video before. These gaps are fucking useless, and if anybody tells you that they are useful, they're retarded. Because if price wanted to balance out that price action, it would have done it on this leg down.
If he wanted,
it didn't need to, though. It didn't need to. It only needed to balance out this price action to continue the trend. Okay, again, this is another good example right here. This is important for inverse fair value gaps and for bullish and for inverse fair value gaps and for regular fair value gaps. Look at price right here at this point in time. Okay, what are we in? We're in a downtrend. When price comes up right here and then moves down, what does that tell us? Once we take out this low, once we continue the downtrend, okay, we have a high, we have a low, we have a lower high, we have a lower low. Once we make this retrace and then move underneath this low, these fair value gaps are now useless to us and must be removed from our chart. Not only to not be used as fair value gaps, but also to not be used as inverse fair value gaps. Why? Because price just showed us right here on this retrace, this candlestick move up, that it only had to move up this much to balance out price in order for the trend to continue down. So you're probably saying, well, these fair value gaps were never filled and they were never balanced out, or they were never inverse. It doesn't matter. They were useless. There's so many fair value gaps on charts that are left hanging, that are left open. I could literally show you guys a fucking billion on every single time frame, on every single chart. There are going to be fair value gaps that are just left there and unused. We need to understand this. When we are in an uptrend and we create, boom, fair value gap, fair value gap, fair value gap, fair value gap. And if we retrace right here, the second that we move up past this high, these fair value gaps mean nothing. Because price is literally telling us that price only had to retrace this low in order to continue the uptrend that we were in. And the second that we close above this high means that the uptrend has continued. So why on earth would it make sense for price to come all the way back down here to fill these gaps, but also in turn break the uptrend that we were in that would have supported these gaps? Again, see how it doesn't make sense? These gaps are not existent anymore. They're not necessary. Okay? This is super, 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 super important. And I know we just went on like a little tangent there from inverse fair value gaps, but it's super, super, super important. When we have a stack of fair value gaps, let's show an example. When we're talking about inverse fair value gaps, okay, this is a good example right here. We're in a downtrend. We have a bearish fair value gap right here. When this candlestick closes above this fair value gap, are we in an uptrend? No, not yet. Why? Because there's another fair value gap right here. Why is this fair value gap still valid? Because there hasn't been a retrace and a move underneath the most recent low yet. This is a fair value gap, and this is a fair value gap without a retrace yet. Versus if we were right here with price action and we made a bullish candlestick up right here, and then we moved underneath this low, then what would that do to both of these fair value gaps? Invalidate them, because price only needed to retrace up to this point in time, and that retrace ended up giving us the liquidity necessary for us to move lower and for us to move past these lows, pretty much saying that we no longer need anything up here. This fair value gap is useless, and this fair value gap is useless. Get it off of your screen. So again, these fair value gaps are valid until we get a retrace. Let's say we get a retrace into this gap and then we get a reaction out of it. Awesome, beautiful. This gap was used. This gap is now useless and will no longer be used and is no longer useful for fucking anything. Okay, so let me just play this out here. Right now, we are in a downtrend. Boom. What trend are we in now? Still in a downtrend, because price has the potential to still fill this gap, because this is the first retrace. This is a retrace. Price hasn't broken structure to the upside, and there's still a gap that price could potentially fill to push us lower. What trend are we in right now? We are still in a downtrend. Why? We haven't invalidated this gap and we haven't closed above this high yet. Now what trend are we in? We are now in an uptrend because we invalidated this gap. Boom. And we close above the most recent high. Move up, then a move down. The highest point of those two candles. Now we are in an uptrend. Super, super important. So that clarified some things on fair value gaps, and that helped us identify inverse fair value gaps. Cool. I know we went off on a tangent there, but that is by far one of the most useful tangents that you guys will be able to use in your guys' trading. Oh, man. All right. Wow. Still got some time here. Sheesh. Give me a second. I'm going to go pee. I'll be right back. And I need to tell the guest speaker that we have that he's going to come on a little bit later.
Oh, it might be live. It might be live. I guess it could just be a whole VOD. This man goes pee with the door open.
Gonna tell him.
Guarantee you we hear him pee. Guarantee this motherfucker pees. He does that shit on purpose, bro. He did it like right off rip and fucking threw me, man. I was laughing so hard.
Sheesh.
He closes the door to come back into the room, though.
Oh, man. All right. We got through a lot of stuff here. So again, let's go back.
I think we're all right on
2 hour handy dandy cheat sheet here. When we're building out our strategy, what are we looking for? Orders to potentially get filled. How do we identify that? Through draws and liquidity, through highs and lows in the market. Then we're looking for a change in the trend to confirm that orders have been filled via break of structure, inverse or rally gaps, or a 79% extension closure, which we will get into later. And then from there, we're looking for a continuation of that trend via fair value gaps and equilibrium, which we have identified. So now we need to understand 79% extension, but before we get into that, I'm going to talk about SMT divergences. Now, if you guys are trading foreign exchange or commodities, this does not apply to you. This is only applicable to people that trade the two indexes, which is the S&P 500 and the NASDAQ, because the divergence is between those two indexes. So I'm sorry to Forex traders or commodities traders, this just doesn't apply to you. However, if you guys are index traders, this is going to be one of the most useful confluences that you guys are going to use in your trading. All right. Give me 1 second. Okay, cool. I'm just making sure that speaker is locked in. Okay, cool. So, in SMT divergence, what is it and how is it beneficial to us? Essentially, we are using these two indexes, the S&P 500 and the NASDAQ, to look at one and look at the price action of it and be able to use it to tell the future of what the other index is going to do or what the other index plans on doing. Okay. Again, just like all of the other confluences that we have mentioned in the past, these are absolutely and utterly useless, just like all the other confluences that we have talked about, unless they are used correctly. And SMT divergences are SMT divergences are used to help identify when one index is already changing its trend, okay, and the other index is just late to the party, okay? So how can we identify this? It's when one index makes a high and then a lower high, pretty much indicating that it's changing its trend, right? So let's say that NASDAQ makes a high, or here, I'll show a better example. Better example. Boom, we're in an uptrend, boom. NASDAQ sweeps liquidity, creates a high, and then boom, creates a lower high, right? Let's say that this is the NASDAQ chart. However, on the S&P 500 chart, this is what the S&P 500 chart looks like. Where on NASDAQ, we swept out liquidity, we broke structure, and we made a lower high saying that, hey, we swept liquidity, we filled orders, we broke structure, and now we're continuing this downtrend. But on the S&P 500, we get boom, a move up. And then another higher high. The S&P 500 is just late to the party. And the NASDAQ is essentially signaling to us, hey, we've already filled the orders. We've already broken structure. We're going to continue this trend down. And the S&P 500 is just lagging. And eventually, it's going to end up coming down, breaking this structure, and then moving down with it. So SMT divergences just help us by looking at the two different indexes and can help us see, okay, on NASDAQ, we made a lower high, but on the S&P 500, we made a higher high. So the NASDAQ is the leading index to the downside, and the S&P 500 is the lagging index. NASDAQ is pretty much telling us what the S&P 500 is eventually going to end up doing. It's going to end up going lower. So an SMT divergence to the downside is, and again, it doesn't have to be NASDAQ to the S&P 500 or the S&P 500 to NASDAQ. It can go either way. Bearish SMT divergence is when one of the index makes a higher high and when the other index makes a lower high. Okay. And a bullish SMT divergence is when one of the indexes makes a lower low and the other index makes a higher low. The index that makes the higher low is telling us that this index is lagging and is eventually going to move higher. For the bearish SMT divergence, the index that makes a lower high is signaling to us that this index is lagging and is eventually going to move lower. So let's show examples of this, and then let's talk about how this can be useful in our trading. Let's find some examples here. This is a good example right here. Recently, look right here. So what do we see here? On the S&P 500, what do? We come up and we push above this high. So we have a high right here, and then we have a higher high on the S&P 500. However, on NASDAQ, we have a high right here, and then we end up making a lower high. So what is the NASDAQ telling us about the S&P 500? It's telling us that, hey, even though the S&P 500 closed above this high or pushed above this high in general, it's telling us that, hey, we're going to go lower and the S&P 500 is just late to the party and you should probably get in shorts because we're going to go lower. And oh, would you look at that? What a perfect signal. It did end up going lower. Okay, so that's an example of a bearish SMT divergence where NASDAQ made a lower high, but the S&P 500 made a higher high. We can use that as a confluence to show that, hey, price wants to go lower. All right. Let's show this in a bullish scenario. Look at this right here. We have these lows right here. Let me make sure I'm marking out the correct ones. When was this? August 20th. We have these lows right here. On NASDAQ, We have these lows, and then we make lower lows right here. We sweep out liquidity. Okay, we make lower lows on NASDAQ, but on the S&P 500, we have those same lows. We end up making a higher low. The S&P 500 is essentially telling us that, hey, even though NASDAQ pushed underneath these lows, this downtrend, whatever, this high time frame downtrend that we're in, it's not going to continue. And this is actually a liquidity sweep. This is ES pretty much telling us, hey, we're not going any lower. NASDAQ is behind, and we're going to move higher here because this is a higher low than these lows, and this is a lower low than these lows. So NASDAQ is the lagging index and is going to want to catch up with the S&P 500 and move higher. Okay, now you're probably saying, well, what type of confluence is an SMT divergence? An SMT divergence, it's not a it's like both. It's both a continuation confluence and a confirmation confluence. And when we fully break down our strategy, I'll show you guys in each, I guess, step of our strategy how and where an SMT divergence is used both as a continuation confluence, but also can be used as a confirmation confluence, because it can be used to show the continuation of the current trend that we're in, but also in the example that we showed, like right here, it can show and mark the bottom and the reversal of a trend, right? And it can be used as a confirmation confluence. All right. So before we add that to this, I want to talk about 79% extensions. All right. Man, I know that this has been a lot of info. Thank you guys for staying on here for all this time. We are plowing through this. This has been a lot. So there's already been some people that have dropped off. So for everybody that has made it this far, you guys are some fucking dogs. All right. So 79% extension, super easy to identify. It's a confirmation confluence, same exact thing as a break of structure and inverse for value gap. I'm not going to go too deep into it. It's literally just as simple as identify what trend we're in, just like how we do with all of our other confirmation confluences. So for an uptrend, boom, we identify, awesome, we're in an uptrend, and let's say that, boom, we came up and we swept out liquidity and we're looking for price to change direction, right? All that we do is we grab our Fibonacci, we draw it out like we're drawing out equilibrium. We take it from the most recent low up to the most recent high. And I'm going to go ahead and let you guys copy my settings real quick.
It's the only good fight there is. It's the only good fight there is.
Okay. So again, now that you guys have these copied, we're looking at
there is
really none of these other marks besides the 79% extension. Okay, the 79%. So when we're in an uptrend, we take the Fibonacci from the most recent low to the most recent high. And all that we're waiting to do, it's literally just like break of structure, except it's a little bit earlier. Whoa. It's just a little bit earlier. And all that we're waiting for price to do is give a candlestick closure underneath this line. instead of this most recent low. That's all we're waiting for. We're just waiting for a candlestick closure underneath the 79% extension. Okay, so it's just like break of structure, it's just a little bit earlier. And then same thing when we're in a downtrend. We're looking for, let's say, okay, we swept liquidity. Now we're looking for our confirmation confluence. Okay, we take it from the most recent high down to the most recent low. And then all that we're waiting for is for price to close above the 79% extension. Right here. Okay. Now, I would like to preface with this confluence here. I don't use this that often. I prefer, and I typically use break of structure and inverse fair value gap over this. This is like last resort. So if there's no potential inverse fair value gaps in sight, and if the high or the low for price to break structure is like super high up or super down low, so let's say that we're in a downtrend, right? And the swing down is like all the way down here. And for whatever reason, there's like no fair value gaps throughout this entire leg down, right? To give us an advantage to be able to look for whatever, an early entry or early look for us to be able to see that, okay, we're actually going to change direction. And for us to be able to break structure, we have to close above this high that's all the way up here. And there's no fair value gaps. That's when I'll use the 79% extension. And believe it or not, even though, it's pretty close to the most recent high, sometimes that's the advantage that you need over the market. And it can be useful in some cases, but for the most part, I'm almost always going to be using break of structure or inverse fair value gap. I only use this like when in dire need. Okay, so I want to preface that. Wow, guys. We have officially covered every single confluence that is necessary for our strategy to take place. And I'm sure some of you guys are sitting here scratching your head saying, well, hey, whatever happened to those order blocks and whatever happened to those breaker blocks? Nah, bro. I've seen over the past 6 months that one, teaching people order blocks and breaker blocks confuses them more than benefits them. And two, when an order block or a breaker block gets filled, either a fair value gap gets filled as well or equilibrium gets filled as well. So there's literally no reason to even mark out or use order blocks or breaker blocks. I've just seen so many times over and over and over again that people, they struggle marking them out. They struggle using
TJR,
them.
bro. He knows I'm dumb.
And as time has gone on, I just look and I'm like, okay, what confluences am I using the most? I'm only using fair value gaps and equilibrium, because even if an order block or breaker block gets filled, equilibrium's getting hit anyways, or a fair value gap is getting hit anyways. So why do I even need those? You don't need them. So for the people that are going to ask about those things, they're fucking useless. Not that they're useless, but the confluences that I've talked about today are the only ones that are necessary, at least in my opinion, to give us the probability that is needed for us to beat the market. Now, holy smokes, guys, we've covered literally every single confluence necessary to build out our strategy. We talked about how to identify them, how to use them, when they're invalid, when they're valid. You're probably saying, yes, holy shit, dude, can we get into strategy already? It's been 3.5 hours, and I would love to do that, but there's still more to cover. Not necessarily with confluences, because confluences is just one step or one piece of the puzzle, but it's with time and timing the market. So there are 3 sessions. Finally, we can chill out a little bit about, marking out confluences and talking them out. Okay. We can finally start talking about the timing of the market. Okay. And what sessions there are and how we can use time to our advantage, because it's one thing just putting these confluences together so that it makes sense in our head, but it's also another thing with timing the market to our advantage so that we know that the market is going to move in our favor at these specific delivered times, or when price wants to deliver high probability price action for us. Because again, if you were to just put all these confluences together in a strategy and execute every single time that the strategy presented itself, believe it or not, you would still be unprofitable. Because if you were executing during Asian session, when these US indexes are closed and the US, and there's no US money being put into the indexes, then you're probably going to lose. If you're taking trades during the London session on these US indexes when the US market is closed, you're probably, and more often than not, going to lose these trades. Okay, so we want to be taking trades during New York session, so we need to be able to identify every single session's times. And on top of that, we need to identify the times during New York session that price gives us and time gives us the highest probability of these things playing out. So let's get into it. Important times for us to know, and this is going off of Eastern time. If you guys are on Pacific Standard Time, if you guys are in freaking China, if you guys are in India, I don't give a fuck. We're using Eastern time. And that the reason why we're using Eastern time is because that is what the US stock market moves off of. I'm not even on Eastern time right now, and my brain and everything that I do work-wise is built on Eastern time. Okay, I'm an hour ahead of Eastern time, and I still do everything as if it's on Eastern time because this is my job. Okay, so all of these times that I'm going to tell you guys, it's on Eastern time. So the first thing that we need to make sure that we're doing is that our trading view is set to Eastern time. So go down here, pull up your computer, or just put a note in your notes to make sure that your guys' shit or your guys' time is set to Eastern time, or else you guys are going to be trading who knows fucking what session. Okay, so make sure it's just click to New York, okay, because that's going to be Eastern time. All right, so there's 3 sessions that we need to know and understand. London session, Asian persuasion session, and New York session. London session goes from 3 a.m. to, now, I'm going to write this down, but I'm going to preface this. So London session starts at 3 a.m. and actually goes until 11 a.m. Eastern time. However, we are going to want to mark it off as closed at 8 a.m. or sorry, 8:30 a.m. because at 8:30 a.m. is when New York pre-market starts. So we only want to mark out the session times when it's just that session that is open. All right. Asia session goes from 1800, oops, 1800, so that's 6 p.m. Eastern time to 3 a.m. Eastern time. And then New York market opens at 9:30 Eastern time, AM Eastern time. The pre-market opens at 8:30. So we can go ahead and add New York pre-market. New York open is at 9:30 a.m. And then it closes at 1600 or sorry, no, 1700 or 5 p.m. Eastern time. Okay? These are very important times that you guys need to know because they are going to tell us significant highs and lows or draws and liquidity in the market that are going to be beneficial for us. And these sessions help us establish our daily bias and help us establish our daily profiles to help us understand where the market wants to go on any given day. All right. So London session is from 3 a.m. to 8:30 a.m. Asian session is from 6 p.m. to 3 a.m. Let me move this up. Boom, so it's in line. Bruh. Okay, there we go. Okay, so boom, Asian session opens at 6 p.m. Eastern time. It closes at 3 a.m. Eastern time. London session opens at 3 a.m. Eastern time. It doesn't technically close at 8:30 a.m. Eastern time, but that's when New York pre-market opens. And then New York market opens at 9:30 a.m. Eastern time and closes at 5 p.m. Eastern time. You're probably saying, well, what happens in between 1700 and 1800? Nothing is open, and that is spread hour. You never want to be trading during spread hour because no markets are open and the spreads widen drastically. That's especially if you guys are trading Forex and commodities. You guys don't have to worry about it if you guys are trading futures because you will never be trading at that time. And if you guys are trading Forex and commodities, you shouldn't be trading.
What a marathon, man.
At that time anyways, because there's going to be no volatility because no markets are open. Okay. So we want to write these things
your
down.
mother knows all about spread out, I'll tell you that.
Now, we use these times to identify session highs and session lows, previous day highs and previous day lows to help us determine what our daily profiles are. Okay? Cool. You guys have these written down?
Yeah, you already wrote them for me. Damn it.
Cool. Now, the last thing that we're going to get into before putting all of these confluences together is identifying our daily bias and identifying daily profiles, okay? So that when we come into the market, coming into New York market open, we can easily identify what direction we want to trade into, okay? And then we can get into strategy creation and put everything together. Okay, so daily profiles. There's 3 daily profiles that we have. There's 3 of them. Okay, we will always have one of these profiles present themselves every single time. Wait, notice these? Wow, no, nothing crazy. Okay, so there are 3 daily profiles. every single day, one of these profiles is going to present themselves. It's either London session manipulation into New York reversal. That's the first one that can happen. The next one that can happen is London session manipulation reversal, New York continuation. And the last one is London session consolidation into New York manipulation and reversal. Now, we are able to identify these daily profiles by looking for manipulations or lack thereof, or lack of manipulations, okay, of our significant draws on liquidity. So high time frame, highs and lows, previous session highs and lows, okay. And all of this is going to make sense when we start getting into our actual execution and our actual strategy. But again, we're able to identify these profiles by looking for manipulations of our significant draws on liquidity. Our significant draws on liquidity are high time frame highs and lows, previous session highs and lows. I'm going to show you guys how to mark those out. Okay. And then on top of that, on top of these daily profiles, we want to prioritize targeting low resistance, high time frame, significant draws on liquidity. Remember, we want to trade away from high resistance liquidity. So this is our high resistance liquidity, and trade towards low resistance liquidity. So if we have highs stacked up here, we want to be trading towards that and make sure that that is in line with the daily bias that we have going into the day. So what I'm going to do right now is I'm going to just show you guys examples of these profiles playing out without without showing you guys how to enter. And then once we can just show and prove that these profiles work, we can then get into our entry strategy and putting everything together. Okay, so let's get into this here. Let me go and let's just do, fuck it, let's go to like here. Sure. So what we're going to want to do, let's just start from this week. So this is Monday. So this is New York market open right here. 9:30. And then what else are we going to want to do? We're going to want to mark out London session. So London session starts at 3. Then we're also going to want to mark out Asian session. Asian session starts at 1800. You guys have these written down? You guys remember? You guys have what these are? Because I'm going to go ahead and get rid of this. Give you guys a second to write them down, just in case.
That one I wrote down. They have pretty good notes, man.
All right. Whew. Okay. So let's look at this right now. First thing that we're going to want to do is mark out session highs. Okay, this is kind of getting into our strategy, but this is what we're going to want to do. Okay, we want to mark out significant highs and lows in the market. Okay, and mark out our session highs and lows in the market. So if we look at London sessions window right here, we see, boom, this is London session high. It's actually right here. This is London session high. And then boom, this is London session low. This is Asian sessions high, and then this is Asia sessions low. Now Asia sessions high, we can go ahead and get rid of that because London session moved through it and it didn't really cause much of a movement. Again, so that draw on liquidity is not useful for us anymore. So we've marked out the session highs and lows that matter. And then if there's any other hourly highs and lows that we want to mark out, we can. So we have an hourly low right here, a move down, then a move up. Sure, we can go ahead and mark this. We can also go ahead and mark out this hourly high, and then we can do the same thing on the 4 hour as well. Okay, but for the most part, when you mark them out on the hourly, they've all been marked. Okay, we're not going to get into entries just yet, but I'm just going to show you guys these daily profiles moving and happening in real time. During London session, did we sweep out or cause any form of manipulation of a high time frame high or low? The high time frame high right here, high time frame low right here, previous session low right here. No. So if we don't see any form of London manipulation, what does that mean? What daily profile does that put us in? There's two daily profiles that start with London manipulation. London manipulation, New York reversal. London manipulation reversal, New York continuation. And because London session didn't manipulate any high time frame highs, there only leaves us with one daily profile that this could be. New York session, manipulation and reversal. Now let me show you guys exactly what happens when New York session opens. New York session opens on this candle right here. What do we end up doing? We move down, we manipulate London session low, we manipulate Asian session low, and then we reverse to our previous draws on liquidity that we had marked out before. That's one of our daily profiles happening in real time in front of our face. We see that London session didn't do anything. There was no form of manipulation, no form of reversal. Awesome. We know that it's going to be a New York manipulation and reversal. So we can expect for New York to want to push into one of these high time frame draws on liquidity to manipulate, and then we can expect to look for New York to give us some form of reversal towards our other draws on liquidity. Let's go to the next day and let's see what daily profile it was. So let's go ahead, boom, Asian session, London session, New York session, okay. Asia session high, Asia session low, London session low, and then we have London session high right here, and then Asia session high right here. London session highs and lows end at 8:30. I forgot to preface that because 8:30 is when New York pre-market opens. Okay, we've marked out the session highs and lows. What else can we do? We can go ahead and mark out other hourly highs and lows that we have. So we have an hourly high right here. We have an hourly high right here. We have an hourly low right here. Hourly low right here. Another hourly low right here. Another one right here. Sure. That's great. Okay, so the first thing that we want to do, I know this looks freaking crazy with all of these drawings on here, but the first thing that we want to do is we want to look at London session and look at what London session did. Okay, so London session opened, we come down and then we swept out Asia session low. So awesome, London manipulation and then reversal. So at this point in time, like right here at around 7:30, we're probably thinking, okay, we're going to want New York market open to be able to give us a continuation. However, once London session starts taking out these high time frame draws and liquidity, that objective is taken out. So the manipulation and the reversal objective of taking out these previous session and these previous hourly highs is now taken out. And that was taken out before London session even closed. So that daily profile has been taken care of completely by London session. So now we need to see a new daily profile open up. And there's really not much time for that to happen besides New York pre-market. Well, during New York pre-market, what do we see happen? We push past London session highs, we push past Asia session highs, we take out, boom, hourly high here, hourly high here. So this is now New York manipulation and reversal. Because the London session daily profile played out throughout all of London session and completed the daily profile. So that leaves New York with a brand new daily profile for it to create, which in turn was it sweeping out these highs, sweeping out draws on liquidity, New York manipulation, and then reversal down to manipulating these highs and then reversing down to significant draws on liquidity through London session lows, previous day lows, hourly lows, and 4-hour lows down here. Let's go to the next day and then show or see what happens then. Boom, so that was New York. Let's go put on Asia session, London session, New York session. Okay, so this is another, I mean, geez, bro, we're only getting New York manipulation and reversals, but we'll hopefully, as this week goes on, get other daily profiles. But here's same situation. We look at London session. Did London session manipulate any of our significant draws on liquidity? We have an hourly high up here. We have London session low right here. We have another 30-minute low right here. We have Asia session low right here.
Oh, it is live. Look at his time.
Asia session high right here. Yes, London session does take out Asia session high, but we don't see a strong reversal off of that. So that draw on liquidity is then invalid to us. Boom. Cool. Okay. We'll kind of speed run through this so we can get into actual executions here now that we're like slowly starting to understand daily profiles. But daily profiles, the main reason why we have them is literally just so that we can use session highs and lows to our advantage and look at what is happening off of them. So again, New York market opens, awesome. We come down and we take out draws and liquidity to the downside, New York manipulation, reversal back up to an hourly high up here. I want to find other examples of the other daily profiles playing out, so I'm kind of going to speed run through this now. Still nothing. This is still, again, another New York manipulation. Hopefully you guys can start seeing these just happen. Again, we look at London, London session. London session, do we take out any significant draws on liquidity? No, but right when New York market opens, we come up, we sweep out, boom, these highs, we sweep out London session highs and then go down and target London session highs, or sorry, London session lows, Asia session lows, previous day lows down here. Let's see the next day. If we can get any sort of this was Trump tariff news. Or wait, no, that was a big liquidation event. Let's see. Still same. Let me go to the next week. I want to find the other examples of the daily profiles just to show you guys, and then we can get into actual execution work. Okay, here we go. Finally. Okay. Nice. Okay. All right, cool. So this is a good example of London manipulation, New York reversal. So we can see that during London session, we're slowly but surely chugging down to manipulate these hourly lows right here. Okay. We get the manipulation during London session. However, we don't get that full reversal up towards our significant other draws and liquidity to complete the daily profile, okay, before New York market opens. So when New York market opens, we can sit here and we can say, okay, London session manipulated, but we haven't gotten the full reversal to complete the daily profile up towards at least our most recent highs here. So what are we expecting New York session to do? To continue, or sorry, to reverse and then target these highs. So again, London session, we're slowly coming down, manipulating. Boom, we manipulate these lows, and then boom, New York market opens. That's when we get the reversal up to these highs here. Okay, let's find one example of London session, manipulation, reversal, New York continuation. And then we can get into executions of our strategy. And it has been a long day, guys.
It's not even a full shift, brother. Come on now.
Okay, so this one, hopefully you guys can see it. This is a New York London session consolidation because London session doesn't really do anything here. It's a New York, boom, manipulation of these lows, reversal up to these highs. Still trying to find a London session, manipulation, reversal, New York continuation. Maybe one day we will be able to get one. This one is not going to be one either. Nothing. I'm just going to speed run through these until we can find one, boys and girls. Nope. This one, again, New York, manipulation, reversal. If I can't find one, then we'll find one when we're doing the executions. Oh, here we go. I think we might have found one. Finally. Okay. It's perfect. Here we go. So let's look at London session here. This is when we're going to want to whip out the high time frames so we can mark these out. So let's go ahead and mark out our high time frame draws and liquidity. We're going to want to mark these out every single time, but I've just been speed running this. Here we go. So this is perfect. What do we see London session do? Boom. The second that London session opens, we come down and we manipulate these high time frame lows. Then what does London session do? We reverse. Beautiful. Okay, so we get that London manipulation, reversal, and then coming into New York market open, we end up continuing that move up higher and higher up towards other significant draws in liquidity. All the way over here, okay? And there will be more examples that we can show during the executions part, but I just wanted to show you guys the 3 daily profiles playing out. Now is the moment that you guys have all been waiting for, the glorious strategy, okay, of putting all of these confluences that we've learned today together to be able to actually predict where price wants to go with a high probability on a daily basis. Now, something that I need you guys to keep in mind, is this strategy going to give you a 100% win rate? No, because again, we're just trying to have a high probability. There's no such thing as a 100% win rate strategy. So maybe on Monday, when you guys get into the markets, okay, Monday when you guys get into the markets, you guys are going to be like, yes, I can't wait to test out TJR's strategy that he taught me in the 3-day combine. I'm so fucking pumped. Let's do it. Okay, and actually for the VIP people, we are going to be doing a live trading session on Monday. So I'll be talking you guys through market open and talking you guys through all of that. So if you guys are part of VIP, then you guys will be there for that on Monday. So you guys won't be making that mistake. I'll be going over it with you guys. But
Bling.
understand that this strategy, it does not have a 100% win rate. But what does it give us? It gives us a high probability of being correct in where price wants to go. So does that mean that there are losses involved? Yes. However,
Because more
what does this strategy give us? It gives us a high probability. And because we know that it gives us a high probability of predicting where price wants to go, it should tell us that, hey, every single time that this strategy presents itself, it gives us the confidence to be able to press buy or to be able to press sell, because we know that probability is on our side. And because probability is on our side, we get that awesome side effect that comes with being able to predict where price wants to go with a high probability on a daily basis, which is money. And that's our main goal of trading, right? That's what every single one of you guys said at the beginning of this damn near 4-hour long call that we've been on so far, boys. This has been crazy. Okay. But that is every single one of our end goals, right? That's the best awesome side effect of trading that every single one of us wants. It's to make money. But it is going to be impossible for us to make money unless we execute this strategy flawlessly, and we do not enter unless our strategy tells us to. Okay? We are not allowed to enter unless our strategy tells us to. Okay, so now we learn the confluences. We learn the times. We know what we have to do, and we know how all of these things work. Now let's put it all together and let's make sense of it. This is going to be something that you guys are going to want to write down or take a screenshot of as I put this in. This is literally just going to be step by fucking step, exactly what we're looking to do every single day. And if price does not give us this, then we are not entering. It's not, oh, well, maybe. No, it's, does this happen? Then does this happen? Then does this happen? Then does this happen? If all yes, then I'm pressing the buy button or I'm pressing the sell button. If not, I'm not here to trade. All right, let's get into it. And you guys should by now have like a good gist or overall understanding of like how we're going to put these confluences together, because I was kind of hinting at it as we were going over them. Because the confluences work together to be able to tell a perfect story of where price wants to go. So our first step is identify where orders can be filled. What did we learn today? Where are orders filled? Where does liquidity lie? Above highs and below lows. Okay, and for us, because we're trying to take significant moves in the market, we're looking for significant highs and lows in the market. Okay, and you're probably saying, well, what does that mean? How? Okay, you're gonna have to teach us significant highs and lows in the market. No, significant highs and lows in the market are session highs and session lows, previous day high and previous day low, 1 hour highs and 1 hour lows, and I'm talking about time frame, and 4 hour time frame highs and 4 hour time frame lows. So step number one is just identifying these areas on the chart coming into market open of where orders can be filled, because that's the first step of our process, is just looking and seeing, hey, where can orders potentially be filled? Because that's what kickstarts our trades, right? We need to see orders get filled and then a trend change. So step number one is identify draws on liquidity. That is in session highs and lows, previous day highs and lows, 1 hour and 4 hour highs and lows. Okay? Once we have identified these draws on liquidity, again, just because we've marked them out does not mean that price has to move off of them. And you're probably saying, well, how do we know what high it's going to move off of? How do we know what low it's going to move off of? We don't fucking know. That's why we mark out every single one of them, because price has the potential to move off of every single one of them. That's why we mark them out. Because above highs and below lows, especially these significant ones that we just typed out, is where price has the potential to reverse. So I don't know if price is going to sweep this low or this low or this low. So what am I going to do? I'm going to mark out every single one of them. And then you're probably saying, well, then how do we know when to press buy? Shut up, dude. We're getting there. Okay, we're getting there. But the first step is just marking them out. The second step is you wait for them to get hit. So you wait for either the high to get hit, or you wait for either a London session high to get hit, or you wait for Asia session high to get hit, or you wait for London session low to get hit, or an hourly low to get hit, or a 4 hour low to get hit. Once our draws on liquidity, or a draw on liquidity, has been hit, that means that price has the potential to reverse. Now, what have we learned today that helps us spot reversals, that helps us spot changes in trends? Break of structure, inverse fair value gap, and 79% extension. Now, what time frame am I doing this on? I'm doing this on the 5-minute time frame. Okay? So once these draws on liquidity get hit, I go down to the 5-minute time frame, and I'm just sitting there and I'm watching and I'm waiting for one of our confirmation confluences to happen to indicate that, hey, we just entered an area where orders could potentially get filled. Now we're sitting there and we're waiting to see and confirm that orders have gotten filled by looking at the low time frame and by looking for a change in trend on the low time frame. How do we identify change in trend? How do we identify change in order flow? Via break of structure, an inverse fair value gap, or a 79% extension. Okay? Whew. Now, once this has happened, we have an area where orders can potentially get filled. And once we get that break of structure or inverse fair value gap, or worst case, a 79% extension. Again, I don't really like using those, but again, worst case, we use it. Then what does that tell us? That tells us, okay, we've confirmed that the trend has changed. Does that mean we press buy or does that mean that we press sell? No. Because what do we have to wait for next? We have to show continuation of that trend. We have to show that that trend is actually going to continue in the direction. Because it's one thing to take out an area where orders could potentially get filled. It's another thing to change the trend on the low time frame, but that could just be a high time frame retrace. So how do we know for certain that price is going to move in our favor? By seeing that low time frame change trend and then also continue the trend in our favor. So step 4 is looking for, go ahead and put confirmation, confluence. Step 4 is looking for our a 5-minute time frame continuation confluence. And what are our continuation confluences? Fair value gap or equilibrium. Now, once the fair value gap gets pushed in, are we immediately pressing buy? Are we immediately pressing sell? No, because we haven't got confirmation that orders have been filled out of to push price in that direction, right? It just filled the fair value gap. Just because a fair value gap gets pushed into doesn't mean that it's going to get respected, because the next candle could boom, inverse it immediately. So what do we have to wait for? We have to wait for price to fill this continuation confluence and then show us confirmation out of that continuation confluence. So what do we wait for? Once we come down and fill either equilibrium or the fair value gap, I'm going to scale down into the 1-minute time frame. While we're within this 5-minute continuation confluence, and I'm going to look for a 1-minute time frame confirmation confluence out of the 5-minute continuation confluence, and I'll show you guys on the chart what that looks like. So the 1-minute confirmation confluence, again, can be break of structure, inverse fair value gap, or again, worst case, 79% extension. Once we have hit an area where potential orders could be filled to change direction, once we've confirmed on the low time frame that trend has changed direction, once we've confirmed that low time frame trend has not only changed direction, but filled a continuation confluence and also expanded and extended out of that continuation confluence, that is when we enter. This strategy is built to not only protect us from fake outs and like literally just harsh ass market conditions, but it's built on like literally how the market moves. Filling an area where potential orders can be filled, confirming that orders have been filled, and then showing proof that that trend is going to continue in our direction, and then we execute. So step number 6 is enter the damn trade. And then step 7 is we look to exit at the other or previous draws on liquidity that we had marked out in the opposite direction. So we exit. This is what it is. I know it may seem simple. Well, I mean, if it were simple and easy, then everybody would do it, but people struggle with this. And hopefully today I've showed you guys at least a simple way to break everything down in a way that makes sense, but we're not done yet today. We still have some more things to go over. Okay, but this is a step in the right direction. So let's just draw this out now. Okay, before we get into the scary candlesticks, okay, let's just draw this out. Let's say we have a high time frame draw on liquidity right here. Okay. We have New York market open right here. And we come up, boom, step one. Phase one, the crash out. Okay, sorry, that was a joke. Phase one, the fake out. Okay. We have an area where orders could potentially get filled to move price to the downside. Price comes up and hits that level. Check, check. Step number two, we go down to the low time frames and we wait to see confirmation that those orders have been filled by either a break of structure, because again, something you guys need to see here, oops. When we're trading up to this high, what trend are we going to be in? We're going to be in an uptrend. Once we get above this high, we're in an area where price could potentially reverse. So once we get past this high here, awesome. We scale down to the 5-minute time frame. We're right here. How can we prove that orders have been filled to the downside? By seeing either a break of structure to the downside or an inverse for value gap or a 79% extension. Awesome. Step three, check. We get a break of structure. Then what are we waiting for? Because this move down could very well just be an hourly retracement for us to move higher, right? So what do we want to show and prove? We want to prove that this downtrend that we just started is going to continue. How can we show that? By either equilibrium, coming up into equilibrium, or a 5-minute fair value gap. Boom. Step four, fill these confluences. Once we get into one or both of these confluences, we scale down to the 1-minute time frame. Because just like how on this move up to take out these highs, we were in an uptrend, even though on the 5-minute time frame we broke structure to the downside, on this retracement up, on the 5-minute we're still maintaining that downtrend that we're in. However, on the 1-minute time frame, we will have likely started a new uptrend by getting like a 1-minute break of structure to give us this 5-minute retrace, right? So on the 1-minute time frame on this leg up, we're in an uptrend. and we're filling this 5-minute fair value gap, that if it is valid, then we will see legs down out of it to be able to, again, win the trade. So we scale down to the 1 minute time frame to see, because on this leg up, we're now in an uptrend on the 1 minute. On the 5 minute, we're still maintaining the downtrend that we're in.
Oh.
And then all that we're looking for is within this 5-minute fair value gap, we're looking for a 1 minute change in direction via 1 minute break of structure to the downside, or a 1 minute inverse fair value gap, or a 79% extension. And then we enter and we target the previous draws and liquidity that we had marked out beforehand. So we go from pushing up, hitting an area where we could potentially fill orders. We confirm that the orders have been filled by changing direction. And then we confirm that the trend is going to continue in that direction. And then we enter and then we target the other draws on liquidity that are in our direction. Okay.
I've been trading completely different than this, man. This is going to be a game changer.
Now, there are some little nuances or things that I want to add to this that I'll go ahead and put in right now. Let me make this back and bigger again. So, some things that I will do when I'm trading using this strategy. This is the only strategy that I use. So I guess you could call these like tips. I mean, they're tips, but it's also like required. You're probably saying, where do we set my stop loss? Stop losses. I put my stop loss under or above the second high or low. Okay, obviously in the opposite direction that I'm looking to target. So let's say we enter on a 1 minute break of structure down here. This high right here is the first high. This high right here is the second high. I put my stop loss above the second high. And then if it's the opposite direction, let me just draw this out super quick. We have high time frame draw on liquidity, come down, boom, we sweep it out, boom, 5 minute break of structure, boom, 5 minute equilibrium. Let's just say we have a 1 minute low right here, 1 minute, boom, boom. This is when we get the 1 minute break of structure to the upside. That's when I enter long. We have the first low and then the second low right here. And then boom, I target the other significant draws in liquidity. So stop losses, I put under or above the second high or low on the 1 minute time frame. The next thing is I always wait to trade until 9:45. This is super important. I always wait to trade until 9:45 a.m. Eastern time. This helps us avoid, when new money is coming into the market, avoid getting manipulated. Because believe it or not, this strategy will present itself before 9:45. And I'm telling you this right now because I've been there and I've done it. Again, this is me being your guys' mentor and telling you guys, I've traded this strategy forever now, and these are things that I've learned that just keep me protected and keep me safe and give me a higher probability in the market, that when you enter on this strategy, or if the strategy presents itself from like 9:30 to 9:45 and you try and enter, you're going to get burned, you're going to get stopped out. Because from 9:30 to 9:45, there is new money coming into the market, and it's causing New York market open to give some form of manipulation. Okay, there's going to be some form of manipulation, and even though, or whatever, the strategy presents itself and you're all hyped up, trust me, bro, you're going to get stopped out more than you win entering before 9:45 a.m. Eastern time. So you wait until 9:40 a.m. Eastern time just to enter, okay? Not for the whole step-by-step to happen, just to enter, okay? So if at 9:45, like boom, that's when you get the 1 minute break of structure to the upside, awesome, boom, guns blazing, take that trade, dude. But until then, I'm hands off and I'm just watching the market play out. All right. I know you guys are probably asking, hey, where's the SMT divergence? Don't worry, we're going to get there. Okay, wait, give me 2 seconds. I need to go pee again. I'm sorry. Oh, man. Wow. Shout out to all of you guys who have been here throughout this entire thing. I know this has been a long time, but man, you guys are sticking through it. And that just proves to me that, man, you guys want this shit bad. So good on you guys. So the next thing that's like, I guess, required with this strategy is if we sweep liquidity. Here, let me space these out for a second. If we sweep liquidity during pre-market or during London session, so let's say it's if it's a London session manipulation reversal, New York continuation, okay, or a London session manipulation, New York reversal, okay? So if we sweep liquidity during pre-market or during previous session, we will almost always manipulate on the lower, on the lower time frame, lower time frames in New York market open. Okay, so what do I mean by that? Let me get rid of all of this. So, all right, so what do I mean by this? Let's say this is New York market open and we have a significant draw on liquidity right here. And this is London session. Okay. This is our draw on liquidity. And London session is coming down. and boom, or let me redo that. London session is coming down. Jeez. London session is coming down. Boom. We get the manipulation and then we get the reversal. So we've already got identify the draw on liquidity, wait for the draw on liquidity to get hit, and then we wait for the confirmation to get hit. All of this happened during London session, and that's completely fine, right? Because that's London session manipulation, reversal. We're looking for New York to continue. We're not just waiting for New York session to open for us to fill a fair value gap and then buy off of that. Okay. What will happen, and I'm going to explain why, more often than not, or almost always, so we'll make a low right here, is coming into New York market open because there's new money coming into the market. New money is always going to want to manipulate what the previous session has done, or at least give some form of manipulation to push price in the direction that it wants to go. So even though we got the high time frame manipulation right here, we have to expect that New York market open from like 9:30 to 9:45, again, that's why we have this here, there's going to be some form of manipulation. Whether it's the high time frame manipulation and then the reversal for us to enter off of that, or if the high time frame manipulation already happened during pre-market or during London session, then we are going to see a low time frame manipulation of a 5-minute low or a 5-minute high. So for this example, we have London coming down, we get the manipulation and the reversal happening during pre-market or during a previous session, and that's fine. But when that happens, we need to expect there to be manipulation on market open on the low time frames. So when New York market opens, what am I doing? And this is something that I can add here. We'll just put this as like 3B. If high time frame liquidity gets swept during pre-market or previous session, we have to wait for some sort of 5-minute manipulation. Okay, and that's the same exact thing as waiting for high time frame manipulation, but just on the 5-minute time frame. And then we continue about our day with our strategy. So let's say New York market opens, we already have check 1, check 2, check 3. We get manipulation, reversal, but the manipulation happened during pre-market or a previous session, so we need to wait for a 5-minute manipulation come New York market open. New York market is going to open, and then we're going to get a sweep of these 5-minute lows. And then from there, we continue about our day on this. Okay, so we're going to want to see a manipulation of these lows. And then we're going to want to, boom, see the rest of our strategy play out. So once we get those lows manipulated, awesome. Then we can look for fair value gap getting filled, equilibrium getting filled, and then it's same old, same old. When we get that retrace on the 5-minute, we scale down to the 1-minute, and then we look for a 1-minute break of structure out of that, and then we enter and then target previous draws on liquidity up here. Now, you're going to ask about SMT divergences. So this is specifically when they are going to be most useful. Typically, when we get a high time frame manipulation during pre-market or during London session, and as we're waiting for that 5-minute manipulation, that is typically when we will see an SMT divergence in our direction. So when we get that 5-minute manipulation, typically what will happen is one of the indexes will give us manipulation and then the other one won't give us manipulation. Okay. And then the SMT divergence is then just a supporting factor in saying, okay, the SMT divergence is showing, hey, this is a low time frame manipulation to continue the trend in our direction. So this just gives me even more faith in the direction that we want to go. Okay. Now, same exact thing with these draws on liquidity getting hit. SMT divergences are supporting rolls with high time frame draws on liquidity. So again, like I showed you guys, there were times on the high time frame charts where NASDAQ swept out lows, but ES didn't sweep out lows. That's an SMT divergence. How can that benefit us? It can put even more strength in our bullish bias if that's the direction that the SMT is showing, right? Because if we're sweeping out lows on NASDAQ, but we're unable to sweep out the lows on the S&P 500, then that's telling us, okay, the S&P 500 is strong. That's telling me, okay, I know for a fact that this sweep on NASDAQ is for sure going to be a good sweep because we're getting an SMT divergence. Because ES isn't even willing to sweep out these lows and it wants to change direction already. That gives me even more faith in taking that trade. So if we have an SMT divergence, more faith in our bias. Okay. Now, I know that this is just a shit ton of information that we covered today. And I don't necessarily want to drag you guys on for too long here and just shove a bunch of info on you guys and like just hope and pray for you guys to digest it. So what I'm going to do here now is for the next 15-30 minutes, we're going to go over examples of us just following these steps step by step to be able to take trades, right? I'm going to show you guys examples of our trades. The next thing that I want you guys to do is go back and look over my trade recaps, okay, and watch me and see how I execute. And again, all of my trade recaps are on YouTube for you guys. Okay, and watch how I execute using this strategy. Okay, because I use this strategy on a daily basis. I will say there are going to be some losses where, and again, they're losses for a reason when I don't follow this strategy to a T. But I can like promise you without a doubt, every single win that I take, I'm following this strategy to a T. Okay. So what we're going to do now for the next 15-30 minutes, I'm going to go over examples of this from market open, just going through this step by step, showing you guys examples of it. And then we have our guest speaker coming on in around 30 minutes. And then we're going to call this one a day. Okay. So make sure you guys stay on for the guest speaker because it's going to be super important. It's somebody that I feel that will be a lot closer to you guys in your journey than you guys see you are to me, right? Because I've been doing this trading shit for a long time and you guys maybe see me as like this super uber-de-duper successful trader that just like has it all figured out. And like, yeah, well, that is true. Like I also make mistakes while trading, but I wanted to bring someone on that is somebody that was just recently in your guys' position, like around a year and a half to 2 years ago, and has been able to change their life forever from the skill of trading. Like, and literally, like, that's how he pays his bills. That's how he puts food on the table. It's from trading. So that's somebody that I want to bring on for you guys. And I'm going to ask him some questions for you guys to hopefully, like, just show you guys what's possible with trading and to give you guys hope. Because, like, again, it's one thing for you guys to get on here and just like see me and try and like whatever decipher all of this shit that I've given to you guys so far today. But I also want you guys to understand like that this is like a very real thing, that it can change your life, and it can change your life a lot quicker than you guys think. So please, please, please wait for the guest speaker at the end of this. We'll get into a couple examples of us going over this, and then your guys' homework for tonight. I know we just did a lot of work, but homework over the weekend and throughout next week, because I know this is just like a lot of information to digest, is just go over those trade recaps that I have on YouTube, and just, again, walk through this step by step and just see how it plays out and see how I'm executing every single day using this strategy. But for now, if you guys haven't already, screenshot this or write it down. We'll get into some examples, and then we'll have our guest speaker come on, and then I'll let you guys go after literally a 5.5 hour long session, boys. This has been crazy. If you guys have made it this far, pat yourself on the back. This has been insane. And hopefully you guys are like getting some fucking value out of this. I mean, this has been a lot of time out of my day and a lot of preparation.
No problem, Devin.
Coming
Thanks
into
for
this.
going
And
back.
tomorrow's even better. We have 2 other guest speakers tomorrow.
Like, subscribe, whatever you
and
wanna
tomorrow
do.
is really where you guys are going to see the
Subscribe, I'll
biggest
have lives
benefit, where we're
probably
talking
by
about psychology and
tomorrow
risk
morning.
management.
The
Because
VODs will
maybe
just
you
be out
guys
for
know
this,
how to execute
really
with this
quick with
strategy,
editing,
or you guys
so.
have seen me go
Kinda what
over
we're
this
all about
strategy
here.
multiple times, and you're like, man, this is the same old shit. I already know this. Well, tomorrow will not be the same old shit. We're actually going to get into very specifically how you guys can change the way that you guys think about the markets, change the way that you guys manage your risk in the markets while executing using this strategy, to hopefully fix those 2 skills that most people struggle with and actually under prioritize when it comes to becoming a full-time day trader. So yeah, guys, pat yourselves on the back if you guys have made it this far, and let's get into some examples here. So I'm just going to go, sure, let's go here. Monday. Okay, what is this, September 9th? So we'll go ahead and mark out the same one on the S&P 500. Damn, I didn't know I went that far back. Whatever. Okay. Let's get into this. Let's go over a couple of these examples. So, boom, we have London session right here.
My turn. I'll close the door when I go
Asian
piss
session
up.
right here. We
All right.
have Asia session low. We have Asia session high. We have London session high. We have London session low. We have previous day low. Previous day high was already taken out. Let's see if there's anything else. Nothing else over here. Okay, cool. Let's do the same thing here on NASDAQ. I shouldn't have done price action so far away. London session high. We've moved up, moved down. Previous day high. Let me mark out London session. All right, cool. So coming into this, I'm going to hate going back and forth between these two. What do we have here? We have London session, manipulation, reversal, New York continuation. Can you guys spot it? London session opens. We push past these highs and push past these Asian session highs, and we start the reversal. Now, during this reversal, do we take out any significant draws on liquidity during it? No. We have Asia session lows right here, and then previous day lows right here, and then whatever, some hourly lows down here. What else can we also see? High time frame SMT divergence. What does that help us do? That helps us solidify our bearish bias. On the S&P 500, we pushed far past these highs. These highs on ES were all the way down here. But on NASDAQ, they're up here, and we make a lower high on NASDAQ. So on the S&P 500, we end up let me just mark these lows out. So on the S&P 500, we swept these highs, but on NASDAQ, we didn't sweep these highs. So we get an SMT divergence. So we get a London manipulation with an SMT divergence that puts even more faith in our bias that we have. And then we start the London session reversal. And during the London session reversal, do we hit any significant draws on liquidity? No, we have Asian session lows right here. We have hourly lows right here, and then a whole bunch of other lows all the way down here. So cool, we're looking for New York continuation. And because we swept out the high time frame draw on liquidity during the previous session, okay, because we, come on, bro. Oh my God, give me a second. Because we swept out liquidity on during the previous session, we're no longer looking for that high time frame liquidity sweep, right? Because the high time frame liquidity sweep already happened, and we already had the break of structure. But because we already had the high time frame liquidity sweep during a previous session, what are we expecting? We're expecting New York market to open and for us to manipulate, still give us some form of manipulation, but on the low time frame. So what am I going to be doing coming into New York market open? This is London manipulation, reversal, New York continuation. Because the high time frame liquidity sweep happened during pre-market or a previous session, that's fine. I'm not looking for these highs to get swept, but what am I looking for? I'm looking for low time frame manipulation. So I'm looking for maybe these 5-minute highs to get swept, these 5-minute highs to get swept, these 5-minute highs to get swept, these 5-minute highs to get swept. Okay. And then once we take out those highs, then we can continue with our with our strategy, right? So let's go ahead and press play. And the reason why I'm doing this on NASDAQ is it's because it's the leading index on the SMT divergence. Okay. And the leading index is the one that is more bearish. Why? Because it wasn't able to sweep out these highs. Okay. So let's go ahead and press play. See what market does. Boom! Right when market opens, we immediately come up. Boom, rip up, take out 5-minute high, 5-minute high, 5-minute high, 5-minute high. Awesome. So we've taken out steps 1 by taking out a high time frame draw on liquidity. That high time frame draw on liquidity got swept and we changed direction. And on top of that, we have even more faith in the liquidity sweep because we have a high time frame SMT divergence on it. Next, because we had the high time frame liquidity sweep during pre-market or a previous session, we're looking for low time frame manipulation. We get low time frame manipulation of these highs. Awesome. What's our next step? We're looking and we're waiting for our continuation confluence. Okay, let's look at the S&P 500 just for context. Let me get rid of this. Okay, so the S&P 500, let's just say we're looking for the same thing, right? We're still looking for, boom, these 5-minute highs to get manipulated. All of these 5-minute highs to get manipulated. And what can we actually notice on the low time frame that we form as well? Not only do we have a high time frame SMT divergence from these highs up to these highs, but NASDAQ, we swept out these highs while on the S&P 500, we're actually unable to sweep out these highs. We have a high, then a lower high right here on the S&P 500, while on NASDAQ, we have a high, then a higher high. On NASDAQ. Okay, and what's the time right now? It's 9:35. So I'm still not looking to trade until 9:45, but we have a lot of things that are going on in our favor and we're following our strategy step by step. So what are we looking for next? We're just looking for equilibrium or a fair value gap to get filled in our direction, which is to the downside. Okay, so let's play it a little bit more. Boom. So we get an up candle on ES, we get an up candle on NASDAQ. Now, believe it or not, we are able to draw out equilibrium right here. Right? Because we got our high time frame liquidity sweep, we got our change in direction, then we got our low time frame liquidity sweep. Now, what stage are we at? We're waiting for our continuation confluence. We're looking for the trend to continue down. We already got the manipulation. So right now, we've actually filled equilibrium on NASDAQ and from high move up to a move down to move down, then a move up. Boom, that's how we mark out equilibrium. So we're in equilibrium right now. So now we can scale down to the 1-minute time frame on both of these indexes. And all that we're waiting for now is a break of structure or a change in direction to the downside. Okay. Okay, so right now, in order for us to get that change in direction to the downside, we can look for either a break of structure to the downside right here. We can look for, let's see if ES gives us anything. Okay, we would be waiting for a break of structure to the downside right here, which we haven't gotten just yet. Okay, and there's no inverse gaps possible on these right now. Again, we could draw out the 79% extension for a closure, and in that case, the S&P 500 already hit it because from this low up to this high, we already closed underneath it, but I don't really like using that confluence too much. Let's just wait for a proper break of structure. Okay, so we get a leg back up. On NASDAQ, we get a leg back up. And what does that end up forming for us? A new low that we can go ahead and mark out. Okay, to potentially see a break of structure off of. On ES, we have a new low, or the low is actually the exact same, to see a potential break of structure off of. Let's play it again. Okay, we get a violent move down. Let's see if we broke structure on NASDAQ. That's the move up. I don't know why it didn't process the next candle. Why is it glitching? Whatever, let me play this a little bit more. Okay, I don't know why it's glitching on NASDAQ, but here we go. Boom, the S&P 500, we end up breaking structure. And I'm pretty sure on NASDAQ, okay, there we go. Yeah, so NASDAQ broke structure right here at 948. That's within our window of time that we're able to enter. The S&P 500 broke structure at 950. Beautiful. We can go short on either of these indexes now. We can go short on NASDAQ. Where do I like to put my stop loss? Above the second high. So the first high is right here. The second high is up here. And then where can we target? Our previous draws and liquidity. So whatever, all of these, or just this one. Okay, this one, this one, this one, this one, whatever, all of these. Fuck it. Let's mark out every single one of them. On the S&P 500, break structure. Boom, where do I put my stop loss? Above the second high. This is the first high. This is our second high. Where can we go ahead and target? We can target, boom, these lows, these lows. There's probably a whole bunch of other lows that we can target as well. Boom, these lows, whatever. We didn't mark out the other draws and liquidity over here, but that's fine. Let's see what happens. So on ES, oh, this was a news day. So there was news at 10 a.m. On ES, we would have been stopped out. On NASDAQ, however, we're still completely intact. Oh wait, and we hit our take profit 1 right here. So we would have taken partial positions off. And at this point in time, price comes up and would have stopped us back out at break even if we had managed partials of our position at take profit 1. But regardless, that's take profits hit on the ideal index that we would have wanted to trade, because we have our high time frame SMT divergence. NASDAQ is the leading index. We want to take the trade on NASDAQ. That would have been, boom, trade hit in our favor for NASDAQ. Let's just keep it playing just to see what happens from here. We can put it on the 5-minute time frame and just see where price goes. I'm pretty sure price ends up reversing back up here, but regardless, take profit was hit. And then boom, the rest of the day ends up going down, hitting out the rest of our positions. But this would have been a winning day. We hit take profit 1, rest of our position gets stopped out at break even. But that's a prime time example of us literally just going step by step. And seeing literally every single one of our confluence get hit, and then us being able to win on a day that even had high impact news, and we didn't even know that there was high impact news. Give me 1 second, I'm going to text okay, cool. Just texting the speaker to get on. We'll do one more example here. And we'll try and speed run through it. Let's just use one, like, let's just use this, for example. Okay. This is previous day lows. This is Asia session lows. Okay, cool. Do the same thing here on NASDAQ. Okay, so we have these pre-market highs, we have these previous day highs, we have London session lows, we have Asia session lows, we have all of these other significant lows down here. Cool. Okay, so coming into the day, do we see any sort of high time frame manipulation? Not really, right? On ES and on NASDAQ, we don't really see any sort of high time frame manipulation. So we're expecting this to be some form. Again, if we look at London session, what is London session doing? It's pretty much consolidating, right? There's no form of manipulation that London session gives us. There's no form of reversal that London session gives us. So what are we expecting New York market to do? Give us the manipulation and the reversal. We can go ahead and mark out these highs as well. just in case. So let's go ahead and play it, see what market does. Okay, market opens here. Okay, so here we go. On NASDAQ, boom, market opens and we come up and we sweep out these 5-minute highs. However, on the S&P 500, we come up and we fail to sweep out these highs. So on NASDAQ, we get high time frame manipulation and we also get an SMT divergence. Because NASDAQ was able to sweep out those highs, but ES was unable to. ES makes a high, then a lower high. NASDAQ makes a high, then a higher high. So we get high time frame manipulation. Okay, so we're looking for New York manipulation reversal. High time frame liquidity gets swept. Check. SMT favoring the direction of our bias. Check. Now what are we waiting for? We're waiting for a change in order flow. Okay, because right now, yes, we're kind of not really too sure what sort of order flow we're in, right? Like we could have broken structure to the upside right here on NASDAQ, but on ES, we're maintaining this bearish order flow, but it's also 9:35 right now. And I'm not looking to take a trade until 9:45. So I'm going to let price play out and just see how price develops here to be able to establish what sort of order flow that we're going to be into. Okay, boom. So here we get another candlestick up. And again, this is why we don't want to be entering like immediately right when price presents itself, because imagine if boom, right when New York market opened, we see, oh yeah, we got a sweep of liquidity right here, then a break of structure right here, and then we filled equilibrium and then we're moving down. I'm just going to want to enter right when market opens. Not only would we have been stopped out, but also if we entered just on this candlestick, we're going to be in serious drawdown now. Okay, on the S&P 500, we're getting legs up here. Okay, so let's just continue. It's 940 now. Let's see what price gives us. Boom. So again, this is another prime time example of why we don't want to get ahead of ourselves. And because again, if we had just entered right here, we would have been screwed over. So now NASDAQ comes up, sweeps out this high again, and comes up and takes out this high time frame high over here. Let's look at what the S&P 500 did. Oh, beautiful. So look, the S&P 500 not only fails to sweep out this high, but also fails to sweep out this high time frame high. Now we have a low time frame SMT divergence and a high time frame SMT divergence. And now if we look at the S&P 500, which is the leading index, which is the index that we're going to want to take the trade on, let's just look. NASDAQ, high time frame sweep of liquidity, awesome. We have an SMT divergence, a bearish SMT divergence on the low time frame and a bearish SMT divergence on the high time frame from these highs up to these highs. And then on ES, from these highs down to these highs and from these highs down to these highs. Then if we look at the S&P 500 in terms of order flow, because that's what we're prioritizing, we're already in bearish order flow. And on top of that, this move up technically, I mean, we could technically classify this as our retrace into equilibrium. We won't do that for this example, but this is technically a time that I would already be looking to enter into a trade, but we're already in bearish order flow. So all that we would be looking for now is that 5-minute retrace into a continuation confluence for us to be able to then scale down into the 1-minute time frame to look to execute. So let's see if we get that. Beautiful. Boom. We get a bullish candle to the upside. Let's see if we fill equilibrium. Boom. We fill equilibrium. Let's scale down to the 1-minute time frame. We push into equilibrium. Now, what are we waiting for? We're looking for a change in direction on the low time frame. Okay, so probably in the form of a break of structure to the downside, right? Because there's no inverse fair value gaps, and I don't really want to use the 79% extension because this low is pretty achievable and pretty safe spot for us to look for a break of structure to the downside. Okay, so let's wait here. Sorry. We have this new low that gets formed. Again, we always want to be monitoring the most recent lows that get made when we're looking for a break of structure. So boom, we get the break of structure right here at 10:03. Awesome. That's when I would be willing to go short. Stops above the second high. In this case, I'm just going to go ahead and put them over this high. We have London session lows right here. We have Asia session lows right here. We have these lows right here and then previous day lows all the way down here, whatever. A whole bunch of draws and liquidity that are just all here that we can mark out, whatever. All of these lows. Let's see what price wants to do. I have no clue what price is going to do. I just chose random ass days. So we come up, we get pretty close to our stop loss, not quite there. Let's see what NASDAQ looks like. NASDAQ looks like actually a freaking mess on this, but we'll see. Okay, so ES, boom, we come down, we hit take profit 1. This is where I'm going to want to manage half of my position, put my stop loss to break even. Awesome. Back-to-back days that I chose randomly that we were able to hit take profits on. Let's keep it going. Okay, so boom, the rest of my position would have been stopped out at break even. It's unfortunate that both the examples that I chose were just one take profit 1 getting hit and the rest getting stopped out at break even, but it's fine. Let's see where the rest of this goes here. Come up, make a new high. I'm pretty sure that this is going to be the same thing as all the last ones, where the rest of the trade, okay, or not. It's just gonna take forever. There we go. So again, this would have hit take profit 1. The rest of the position would have been stopped out at break even, but then the rest of our bias ends up playing out. Again, it's unfortunate. I don't literally pick these examples off of the top of my head, like literally drew them out randomly, but both of them ended up hitting first take profits and the rest got stopped out at break even. We'll go through more examples tomorrow, but what I want to do is bring on our speaker now. So let me go ahead. And let's get into this. Whew. It's been a long one, guys. Let me go ahead and stop sharing this. Fire.
So can you hear me?
Yeah.
Okay, fire.
All right, what's up? So I wanted to bring you on for this. We just did it's been 5 hours. So I've been talking to these guys for 5 hours now, pretty much going over everything when it comes to just strategy and confluences. But I kind of wanted you to wrap up today, more so talking about what it took for you to become profitable, how long was the process, and just giving them sort of perspective on what it takes to actually turn profitable. Because again, these guys just sat through 5 hour long coaching session with me, going over teaching them confluences, teaching them fucking everything, and then tomorrow it's going to be even more of it. So they've already kind of established themselves as people that are willing to do what it takes just by sitting in this. And that's you're someone that I know that has spent, and when you were trying to turn profitable, took a lot of time out of your day to put in the effort and the work required to be able to make this happen. So yeah, if you could just go over your story, and then specifically what are some things that helped you differentiate yourself from everybody else that tries to make it in trading?
Yeah, I mean, I feel like recent days getting profitable is happening a lot quicker than before, obviously, just because of access to information.
Yeah.
But in my day, me getting to where I was within a year was that at that time that was fast. So I mean, the things I was doing to get to that point. Obviously, I worked a job. If you guys think you can do this without working a job, like just kind of unreasonable. Make sure you have a job. But I was just making sure that I always had a job that was outside of market hours, and I was spending as much time as I could on live markets and backtesting. For me, that was what was pushed it forward. What pushed it forward the most was really like the live chart time. So, I guess a basic rundown of what every day looked like for me when I was learning was I'm there for every hour of New York session open. Even I'm not trading the entire time. I would still take like my 2 trades a day or whatever my rule was. But I'm sitting there and I'm watching price move every day, all day. So I'm watching every hour of market open. And then my job was right after market close. So then I'd be delivering pizzas. But I chose that job on purpose. One, because obviously it's outside of market open, but also because I knew that if I'm delivering pizza, I can like watch some like YouTube videos or some shit. So I'm watching the YouTube videos, like educational videos, literally every single day that I'm working. And that would run me until about, I lived in Pacific Standard Time. So I was getting off, I was going to work at 2 p.m., which is an hour after market close. And then I would get off work at about 8 p.m. EST or PST. And then I'd go work out for about 2 hours. And then this is where like I was just being delusional about it, but I do feel like it actually helped. Once I got home from the gym at 10 p.m., I was back testing until London session opened so that I could watch an hour of London session open as well. So the main thing that I was doing that really like pushed it forward for me, I feel like, was watching live markets. Like obviously I'm back testing, I'm watching the educational videos, but the big thing that pushed me forward and like accelerated the success was just live market time and the amount of live market time I was getting. Because I mean, I'm sure you know, like nobody else is really getting that much like live time on the charts. So I feel like that pushed it forward the most for me. And I would say the biggest like turning point for me in trading overall was when I got the actual stats on the way that I trade in my model. So that's why I always mention backtesting, because like that's the only way that you can do it in a reasonable amount of time. Once I had like 6 months of data that showed that I was profitable, the way I started moving after that was just like it was like night and day. Like my confidence just took me straight to where I need to be. So I mean that's the basic rundown.
Yeah, that's what we're going to talk to them about tomorrow is like trade journaling. And like today was really just like going over how to execute, how to read the markets. And like he was saying, guys, this really will not work if you just whatever. Like I know I told you guys like whatever, copy and paste the strategy or write down the strategy down pat. That's like one thing to just have it written down, but you're probably going to be executing the strategy incorrectly at first. You're probably not going to be marking out the confluences correctly at first. And that's where like a lot of people fuck up. They'll just watch one YouTube video on some magic strategy that they think is going to change their life. And then they try and execute it and they're doing it in the complete wrong way. I mean, hopefully I taught you guys the right way. We spent 5 hours doing this today. But again, they just think like, oh, I'm just going to copy and paste the strategy and then it's going to work out in my favor. It's like, no, you guys need market experience. You guys need to put the time and the hours in to actually see, not only to be able to get the confidence to see your strategy play out, but also to get data and like to see the mistakes that you're making for you to actually understand like where there's areas for you to grow. And that's like a big thing that nobody talks about in trading. Is literally just like that's what helped me turn profitable was, again, like I just wouldn't leave the charts. I was looking at, like he was, from market open, bro. I was doing this when I was in high school, so I had all day. Like I was looking at it from market open at like pre-market open actually, so from at 5:30 a.m. PST for me because I lived in California, and then literally all throughout the school day, all throughout after school, and then would stay up until like midnight or 1 a.m. to watch London session play out. And that's what it took for me to be able to get the market experience required, because it's one thing to know the confluences and it's one thing to mark out the confluences, but seeing them actually respect and move the way that they're supposed to in real time just gives you way more faith and way more confidence in your strategy and gives you more confidence to execute. Because again, like you can put confidence in me as a mentor, just thinking like, oh yeah, TJR is profitable and his strategy is going to work for me. But it's another thing for you to actually get the reps in and take the trades yourself, whether it be back testing or in live markets and see these confluences like truly move the way that they're supposed to and cause price to react the way that they're supposed to. And then that will give you the confidence to take the trades that you're supposed to. And same exact thing with him is like, we're going to get into trade journaling tomorrow and how we can actually look at what our stats are, what our profitability or what our win rate is compared to our risk to reward, and then how that can actually equal profitability, and then how to scale like when it comes to sizing and like percent that you're supposed to be risking on your account per trade to be able to make the most of that. But when it comes down to it, like one of the 3 skills of being a profitable trader is understanding your strategy. And not only that, but it's having the market experience required. So you guys sitting here for the past 5 hours, me explaining all these confluences, you guys taking notes, and you guys writing down the strategy. Unfortunately, that's only one step in the right direction. The other steps in the right direction is you guys actually going out and practicing, right? Like you guys just came and watched a 5-hour tutorial. Now you have to actually get the reps in, because it's, you know, like you guys just watch someone work out for 5 hours. Now you have to actually go and work out yourself. And that's when the results are going to come. So something that I want to ask you, Darius, is like, after going through something similar to like what they did, after like learning some strategy or learning confluences, like even after understanding what you were supposed to do and executing and then failing after that, because that's just like bound to happen. It's just like failure and like not being profitable after learning the strategy. What was a turning point for you that helped you get over the losses and the mistakes that you were making without necessarily having someone like that was profitable by your side to say like, yo, this is the mistake that you're making?
Yeah, I mean, it's similar to what you just said. Like, you can't just, you'll almost never be able to just pick up a model, even if it is actually profitable, and just use it. Like, discretion is pretty much always going to be required, and you're only going to get discretion by spending time on the charts. So, I mean, the turning point for me in that sense was, it was just the chart time. Like, sitting there, and I wanted to say this too while you were talking. I think the turning point for me was not trying to like copy and paste what other people were doing, but just sitting on the charts and finding like what actually makes the most sense to me. Because like the way that you trade obviously makes money, but for another person, they could do it, learn it the exact same way, but for some reason it's just not going to click for them. But I don't know, like a different model will click for them perfectly, and now they're making money. Both models make money, but it's just about what makes more sense to you. So I think that was the biggest thing for me, was when I just like decided to be an individual on the charts and just find what works best for me. Like the way that I trade right now, like obviously I use the same concepts as other people and stuff like that, but like the way that I trade right now isn't really replicated. Like I'm pretty much the only one who trades the way that I trade. It's because I sat here on the charts and backtesting and built it piece by piece for years. So, I mean, I would say that was probably the biggest turning point for me.
Yeah, like again, a lot of you guys that just watch me break down like the confluences and the strategy, I've broken that down because that's what makes sense to me. And, you know, for a decent amount of people, you know, they can come in and they can copy my strategy and it makes sense to them. Like why price is moving off of a draw on liquidity, right? That's where like orders can get filled. And then why price is reacting off of an imbalance and all of these things, and why price is going towards like other draws in liquidity, why price is moving the way that it is. And that makes sense to people. But if it doesn't make sense to you, then it's never going to work. If you don't understand and know why price is moving the way that it is, then again, if we think about the definition of trading, the definition of trading isn't to make money. It's being able to predict where price wants to go with a high probability. So how are you supposed to predict where price wants to go if you don't even know why it's moving? That should be the like square one. And that's what these confluences help you do. They help you like understand what price could possibly be doing within these certain price ranges or at certain prices. And then it's up to you guys to sit down and look on the charts and then see that happen in real time for you to actually visibly understand like when this price point gets hit, when this confluence gets hit, this is what follows. Or when a set of these confluences get hit in a certain pattern that helps build out a strategy, this ends up being the end result. And this ends up being giving me a high probability of being able to predict where price wants to go. And hopefully that's what I've helped you guys build out today, is like a profitable strategy that makes sense to you guys for why price is moving the way that it is. But if that doesn't make sense to you, I'm not going to bullshit you guys and just say you guys have to follow my strategy. It's going to be a little bit harder for you guys to go back and do it all the time and spend like hours by yourself, but it's going to be worth it because you're going to be wasting time trying to use a strategy that doesn't make sense for yourself. So that's something that's super huge. It's just like market experience and understanding, and like something that you guys should do as homework after today is back test and just mark out these individual confluences that we've talked out today and watch how they react to, like, as price points get hit. Watch how they move the market, because these specific confluences that we talked about today, we saw in some of the examples that I went over, like they work, right? But you guys need to see it for yourself instead of me just marking it out, because I've been doing this for so many years now, I can't even count. You guys have to do it for yourself and see how price moves the way that it does off of these confluences. The next thing that I want to ask you, Darius, is when it came to like specifically growing in trading, like a lot of people, they'll have like these periods where it'll be like, I mean, I'm sure like me and you, similar experience where there was like a lack of information and a lack of education at the time. And for these guys, they're super lucky because there's just so much info out there and good info on trading. Yeah. But there was often long periods of times for me where I would just be, there was no improvement whatsoever, or I would actually be getting worse. And I'm sure that you went through that as well, where there's just like a period of like, I don't know what the fuck I'm doing wrong. How were you able to find solutions to those problems, or how were you able to get through those slow points where you're like, I'm seeing no improvement right now and I don't even know what I'm doing wrong? How were you able to break past those periods and those like time frames?
I have a story about that actually, because the point where I realized that like I wasn't moving forward, I was actually moving backward, was when my dad like came and said something to me, because I quit doing what I was doing with him, like we were doing real estate, and I quit doing what I was doing with him to do trading. And then time has passed, months and months and months has passed, and I'm making no progress. So he literally comes up to me and is like, what are you gonna do? Like it's been what, 9 months and you haven't made $1. You've actually lost money. Like, what are you gonna do? And I mean, it's kind of a hard answer, at least for how it went for me. There's no like magic pill you can take that's just gonna get you over it. The way that I got over it was I just kept going. You kind of sit there. It comes to a point where you have to sit there and you have to make a decision to just blindly trust in the fact that this is somehow going to work eventually, because you're learning. Because it's not like you're not doing what you're supposed to. You're waking up every day, you're putting a ton of hours in, and you're learning, but you're literally moving backwards. It's like, how can I trust in the fact that this is going to work? Unfortunately, you just have to blindly trust it and just keep moving forward and just make sure that you're actually doing what you're supposed to, though. Because if you blindly trust it, but you're not doing the right work, like you can do a ton of work, but if you don't do the correct work, you're still not going to make it there. But if you blindly trust it and you make sure you're doing diligent work, you're journaling, you're actually studying your losses, you're making sure you don't replicate those things, you replicate your winners, and just keep stacking those wins, eventually it's just going to make sense. Like one day it almost felt like I woke up and everything just clicked. And then like things finally started going my way. So the real answer is you kind of just have to keep working through it and just like find the solution to your problem.
Yeah, I think that's like that's a good way to put it, where like for me, when I would go through like the periods of like I truly don't even know what the fuck I'm doing wrong, it was one like I think a big thing is leaving your ego at the door. I told every single one of these people that came in here when they first started, I was like, you guys signed up to this for a reason. It's because you suck at trading. Like, you guys are not profitable right now. So leave your ego at the door and understand that you joined this for a specific reason, because you guys are lacking something and you want to learn. So like having those periods of vulnerability, not only on something like this where you're supposed to learn, like it's easy to drop your ego and try and learn from somebody that's better than you or that's already successful in a field that you want to become successful in. But it's another thing to do it by yourself, where sometimes you can kind of blind yourself of like, oh, I'm doing every single thing right. Like I know exactly what I'm supposed to do. And it's like, do you really know what you're supposed to do if you're not getting the results that you should be getting if you're doing everything right? And that's when you need to look back and say like, okay, you truly are doing something wrong here. You have to look at the steps that you've been taking and change something, because if you don't change anything, then you're going to stay on the exact same track that you've been on, which is just this unprofitable journey. Like nothing changes if nothing changes, and you don't want to like only take 2 trades and be like, okay, this isn't working, time to change everything. But it should be like, if 2 months or 3 months goes by and your win rate is the exact same and you are still unprofitable and you're not finding success in the markets, you need to look yourself in the mirror and say, what am I doing wrong? Or you need to look at your trade journal and identify the mistakes that you're making. Like that's a huge thing. And we'll get into that tomorrow with journaling your trades, is identify the mistakes that you're making, and your goal should be to never make those mistakes again. Specifically with psychology, that's the easiest thing that you can do to accelerate your road to profitability, is because like once you have your strategy, it's like boom, you have it, and like there's no changing that. And like once you can understand how price is going to move off of certain points, like it's not really going to change. Like once you have that in your head, you know how to execute, and then the only thing that you have to beat is your own discipline and your own emotions that are causing you to take trades outside of that strategy. So right now you guys are lacking kind of all three: risk management, psychology, and strategy. But as you guys start to develop strategy, and as you guys start to understand how price is moving off of certain confluences, and you know where and how price is moving, like let's say you guys are profitable when you're back testing, but for whatever reason you're unprofitable when it comes to forward testing or trading on a live account, then that is directly correlated to your psychology and your risk management, because you know how to predict where the market's going to go, but for whatever reason you're not disciplined enough to wait for your setup to present itself. And that's the next question that I have for you, for them to think about, is like understanding where price wants to go is one thing. And I mean, this is something that every single trader struggles with. Like even I still do it occasionally, where you take trades that just do not follow your system. Is like, how are you able to build the like psychological fortitude and the discipline to, I know it sounds easy, but like to not give in to those trades where like whatever, you have some sort of confidence, like you're on a winning streak and you just think you can skip over a step in your strategy because you're on that winning streak. Like, have there been times for you where your confidence is through the roof, whether it's you've been back testing for the past six months worth of data and you're just like, holy shit, my win rate is 80%, I'm ready to jump in live, and then boom, you jump in live, and because you have overconfidence, you just get fucking crushed?
Yeah, I mean, that's happened to me recently, actually. I was just murdering. Like, I had a week where I made multi-five figures on a live account and took a multi-five figure payout. So I was like, damn, bro, I'm really that guy. And I go into the next week, and in the first 2 days, I pretty much eliminate all my live account profit just because I'm just like too in my head about it. So that was like about a month and a half, 2 months ago. So it still happens like occasionally, even when you're like profitable and you make money. But for the most part, the way that I'm able to get over that, the first one was what I talked about earlier. Like when I got the stats on the way that I trade, the way that I thought about it was just like, I just built a money printer as long as I do exactly what I'm supposed to do. So I have zero incentive to not do exactly this. I know if I do exactly this, it's going to make me money. Why would I do anything else? And then another thing too that I realized was just for like, at least for my personality, I perform better as a discretional trader. Like if I can be as discretional as possible, but still have a consistent framework, it's just easier for me to perform. So it's not like I'm taking, I don't know, like the old TJR model, liquidity sweep, break, structure, fair value gap. Like it's not like I'm sitting here looking for this, and this, but I do have consistent things that I look for. So that freedom just makes me feel less like stress about each trade I'm taking. It's like, oh my God, is this exactly perfect? But I think having that freedom for myself personally was a good thing. But the biggest one was the first thing I said. Like once I got the stats on the way that I trade, like I got the stats on my discretional trading too. Like once I have those stats, it's like, why would I do anything but this? I know this is going to make me money. It makes no sense.
Yeah, no, 100%. That's why, again, we'll talk about this tomorrow, but that's why journaling is like so important, especially for me. And when you make psychological errors too, if you were to look back at your trade journal, especially you guys as unprofitable traders, if you were to, let's say, subtract those psychological mistakes that you made and subtract those psychological losses,
Going.
look and see, like, would you have been profitable if you didn't make those psychological errors, if you didn't make those discipline errors? And then that's like your real win rate. That's your real risk to reward. And that's like the real determining factor of like, okay, are you a profitable trader or not? It's like, yeah, if the answer is yes, then awesome. Your strategy works and your confluences work. Now you know what you have to work on, which is your psychology and your risk management, because that's what's causing you to be unprofitable. And that's something that I always think back on. And I say this all the time on YouTube videos or TikToks where I'll be going through a losing streak and people are shitting on me. And I'm just like, bro, like I'm just laughing in the back of my head because I'm like, bro, probability is on my side. Literally give it a singular week and I'm going to like go on a win streak, or I'm going to wipe away all of these losses. And it's happened for years now, like literally for years, every single time since I started on the internet. I'll go on a losing streak and people will be like, ha, told you this guy fucking sucks at trading, and then boom, like probability on my side. And you guys have to be thinking about that as like yourself as your hater, because sometimes you guys can get in your own head of like, oh man, like my strategy's not profitable, or maybe I'm not profitable. But if you've already done the due diligence of doing your trade journaling and understanding what your probability is, what your win rate is, what your risk to reward is, and you know how price is going to move off these confluences, there's nothing that you have to worry about. And again, that's what we started this entire fucking coaching call on, was just understanding the definition of trading. The definition of trading is just predicting where price wants to go with a high probability on a daily basis. And if you can do that every single day with probability on your side, then you shouldn't be batting an eye at losses. You shouldn't care. As long as you're executing your edge or your strategy flawlessly without making psychological errors, then you know no matter what, money is going to be on the other side of that. Money shouldn't even be something that you think about, because it's almost guaranteed when you have probability on your side. The last thing that I want to ask you is like, for all of these people, whether they're 3 months into their trading journey, whether they're 2 years into their trading journey, or just like a week into their trading journey, what's some like words of advice or some motivation for these guys that are either just getting started or are deep in their trading journey, to show them that, hey, like there is light at the end of the tunnel, and that you guys can actually make this work? Because again, like I tell them all the time, like I'm seen as like some like fictional character to them, because they just see me online and they see me with like a bunch of money living a life that's kind of like unfathomable. But I want to like bring other people in here that like maybe aren't online as much, or you know, like have found success in trading, or just like other ways of trading. Like tomorrow I'm going to have Orangey come on, and I'm also having Umar come on. Like these are people that don't necessarily teach trading online and aren't seen as like these fictional characters that like may be like kind of unreachable or unattainable to them. And just to show you guys, like, look, these are real people that have made trading, and trading has changed their lives forever. So like, what's something that you could tell these people that are either at the start of their trading journey or like just kind of towards the end, and they're like, yo, this is my last shot at making this shit work?
Yeah. I want to say some like actual like on chart advice, and also just like motivational. The first thing I want to say that's just always going to be relevant and is always going to help you figure out why you suck. It's always either your technical skill or your psychology. And it's just really easy to identify. You can get the stats on the way that you trade. If it's profitable, then it's your psychology. It's pretty simple to identify that, but it's always going to be one of those two things. So it's not too complicated. If you're sitting there and you're like, I don't know why this just isn't working, I can't figure it out. It's an easy answer. You either suck or your mental sucks, or both, and you go fix it. It's easy to fix, or not easy to fix, but it's easy to pinpoint what you need to do. But motivational wise, I mean, the reality is majority of people don't make it, but it's not because it's not possible. It's because they don't do what they need to do. So if you want to make it, you need to do what you need to do for a long enough period of time. I think the biggest thing for me that helped me get to the other side was it might sound corny or whatever it is, but like when I started this, and while I was in like the roughest parts of it, I genuinely was sat there and I was decided on the fact that like, I'm either going to be 60 years old and homeless on the streets, or I'm going to make this work. Like I'm willing to ride this out and sit here and put in the work that's needed to be done until I get the result. I'm not saying that I'm going to get the result in a year, or I'm going to get it in 2 years. I will literally wait until the end of my life if that's what it takes. But I will sit here and do what's needed to get it done. And obviously I'm trying to get it done as fast as possible, but that's my point, is that you can't lose if you don't quit. So do the proper work, do the right work, but also be willing to just sit through the mud for as long as it takes to get what you need out of it. And there's really no way you can lose. So I don't know, if you're trying something and it doesn't work, try another thing and keep trying another thing until you figure it out. Eventually it's going to click.
Yeah, I think that that's like a good way to wrap things up is like everybody's on their own timeline towards success where, you know, you may hear some people that whatever get on TikTok and they're like, I turned profitable after 2 weeks of trading, and like maybe they're just some sort of anomaly, or maybe they're fucking capping. And then there's some people that have spent 5 years trying to learn how to trade and they're just now turning profitable. And there's like literally no difference between those two people besides their times that it took for them to turn profitable. They all did the same shit. They all had to learn the same shit. And it was just the timing was a little bit different. So every single one of you guys, whether you guys are at the start of your journey or you're like, yo, fuck it, this is the last shot that I'm willing to take in order to make this happen. Like the way that I like to phrase it is just like, think about what your life would be like if this doesn't work out. Like you right now are not very satisfied with what your life is. And that's how I was. That's how Darius was. Like we were sitting there and we saw what our future was going to look like if day trading didn't work out. And that was something that was super unappealing to both of us. And we knew what trading could possibly do to be able to change our life, and we were willing to risk everything, and we were able to do whatever it fucking took to be able to make sure that that became a reality. And no matter how long it took, no matter if it took a year, 2 years, 3 years, 4 years, 5 years to be able to make that happen, that was what we were set on, and that's what every single one of you guys has to have. You guys have to have that headspace of being so fucking delusional that you're willing to go after this until the wheels fucking fall off, until you're 60 years old, and then maybe by the time you're 60 and it hasn't clicked yet, you're like, you know what, maybe I could have done something different with my life. But I can promise you without a doubt in my head that if you guys are that delusional, that's not going to be the case, and you guys are going to find success in this, because it's the tale as old as time, bro. You ask anybody that's massively successful in what they do, whether it be trading or anything else, they hit rock bottom, they fucking hate the life that they're living, they see a much better, a much crazier, and a super successful life ahead of themselves, and they just put their head down and they put the work in that's required to get there. And again, every single one of you guys that's been on here for the past 5.5 hours, I would like to say that, you know, you guys being willing to sit here and hear me ramble about some crazy ass fucking job that I do on a daily basis, that has changed my life forever. I would like to say that all of you guys have that in yourselves, and that you guys have that delusion and that ability to be able to change your lives. And it's just never letting that go. I think about, there was times that like I thought about giving up, and then the last second I was like, you know what, fuck it, I'm going to give this one last try. And I can't even imagine what my life would look like if I didn't take that chance on myself. I would be a regular ass person. You wouldn't know who the fuck I am, and I would just be another statistic in the system, bro. And that's like the worst way to go about life. Like nobody wants to live life like everybody else. You guys have hopes and dreams, and you guys want to be able to treat your family to awesome experiences. You want to be able to treat yourself to awesome experiences. And this is the route that you guys have chosen to go. So I'm telling you right now, like, put like 2 feet on the side. Don't be half in, half out. Like there's no reason to half-ass this shit, because bro, this is the only life that you guys have. And if you guys are half-assing this, then you're never going to get anywhere with it. You might as well go head first and, you know, take that leap of faith on yourself and trust in yourself that you're going to be able to make it work, because there's so many other people that have made it work for their own lives. Why can't it be you? And that's pretty much how I want to wrap up today. This was long ass coaching call for every single one of you guys in here. We're going to be talking about psychology, trade journaling tomorrow, starting at the same time. Thank you, Darius, for coming on, giving some words of advice to all these people. And yeah, guys, hopefully you guys are ready to survive another long ass session with me tomorrow, going over the shit that Darius was mainly talking about, which is like journaling and psychology and being able to fix those problems in your trading. Because again, I'm assuming that most of you guys came in here, you guys already have some sort of strategy, or you already have some forms of confluences that you know and understand. And I think that's where the majority of you guys are lacking, is when it comes to psychology, and I'm going to whoop you guys into shape tomorrow. So be ready for that. Appreciate you guys for hopping on. Thank you, Darius, for hopping on, and I'll see you guys tomorrow. All right, boys. Peace.
Well, there it was. That was a lot. How do I tell you? So we got a workbook. We'll be going through this workbook. I'm gonna get the live downloaded tonight. We'll get some VODs out for what the lessons were, and kind of just it'll go through with the workbook because that's what I was doing in the video. We're gonna pretty much be doing videos and making clips of this, and basically using it to document when I'm doing the clips. I get the highlights of all of them, and I have to rewatch them, and it's like consuming it 10 times if you're editing it. So that's gonna help me out. It's gonna help document this whole process. I'm gonna be able to look back at it, and as I'm going through trades in the future, I can go back and say, okay, what am I supposed to do until I have it like memorized in my system. It'll see if I have any of my own innovations or anything I would like to see before I make a decision. If I educate myself more, but I think it's going to be a really good option. But we are also still doing the clipping. We're still doing the Spotify. We're still doing the faceless accounts. We're going to be doing all of those things. But like I said, I'll most likely have the VODs out for per lesson for what he covered today. And we'll have clippings of that for honestly, I'm hoping that it grabs his attention and we're able to start doing some calls, or like I'm in the Discord community. I'm a huge community person. I learn more from community than I do like reading, and I learn from the videos too, but it's hard to put everything start to finish like this was. I had a feeling that was going to be my biggest benefit, is start to finish and knowing what's covered, what's going to be covered, things of that nature. All right. Well, also tomorrow we have the VIP is gonna be after hours stuff. I'm not sure what they have entailed for that exactly, but thanks for stopping by, guys. We'll be back tomorrow. Tomorrow starts at 3 p.m. EST. What else we got going? That's about it. So have a good night. See you guys tomorrow.